Hello, welcome back to our revision session. In this session, we shall be looking at the December 2021 sitting of advanced taxation. So welcome and let's solve the questions together. So we start with question 1 of the paper. Question 1 in the current setting is mostly a theory question, and so be keen to be able to look at it keenly. It will always be testing a number of topics, majorly 2 to 3 topics in most cases. So question 1A of December 2021 advanced taxation says, as economies continue to recover from the impact of the COVID-19 pandemic, tax collection in many countries continues to face challenges. This trend has resulted in some revenue authorities resorting to some drastic measures to boost tax revenue. One recent measure taken in monitoring of social media accounts and postings is, to access taxation compliance. Required. Justifying your response with practical reasons, argue the case for or against monitoring of social media accounts to assess taxable capacity and compliance. Note, marks will only be awarded for one position taken. Now, this question is testing what we call emerging trends in taxation. So that reminds you to be keen on all the subtopics in that topic, including issues like high tax, COVID-19 and taxation, tax agents, tax experts, and all that. So in this particular case, we are looking at the impact of COVID-19 in taxation and what tax authorities have resorted to do for them to boost their tax collection. So let's pick the question again. Justifying your response with practical reasons, argue the case for or against monitoring of social media accounts to assess taxable capacity and compliance. And we are told marks will only be awarded for one position taken. So in this case, you were to take one position. That means you are either to argue for or against the monitoring of social media accounts by tax authorities to boost tax collection. But for learning purposes, I've looked at both sides of the coin, so I'll then be discussing arguments for and against monitoring of social media accounts. But in exams, please, in such a question, take one position and talk about it in detail. So one, I'm talking about arguments for monitoring of social media accounts to assess taxable capacity and compliance. Now, today, many business activities are done digitally. So then digitalization and rise of social media has changed the way businesses or other firms conduct their businesses. A lot of firms today do their marketing activities online. A lot of them conduct business and communicate with their stakeholders online. And therefore, the move by KRA and other tax authorities to monitor social media accounts helps such authorities to maximize on their tax administration, and therefore digitalization, in short, and the rise of social media accounts enhances the way people conduct business today, and therefore the move by KRA to monitor social media accounts is a new frontier in tax administration. Number two is that tax is a constitutional obligation that everyone has to bear fairly, and therefore all people must pay taxes, and therefore nobody is to pay a shilling less or more than what they should actually pay. And therefore, the move by KRA to monitor social media postings is therefore a good one to complement the traditional methods or traditional tools that were used by such authorities to ensure tax compliance and administration. Three is that monitoring of social media accounts supplement what we call lifestyle audit activities, such as wealth declaration by taxpayers, in order to determine whether such taxpayers are tax compliant or not. And through such audits, such authorities, including KRA, have been able to make or rather take enforcement actions against non-compliant taxpayers. In other words, I'm saying that monitoring of such social media accounts supplement or complement lifestyle audits by tax authorities to ensure maximum tax compliant by taxpayers. So those are some of the arguments for, and as I said, I'm looking at both sides of the coin. So the second bit, I'm looking at arguments against social media monitoring by tax authorities. One is that most tax regimes, including Kenya's tax system, is based on what we call self-assessment by taxpayers, founded on honesty and trust, where taxpayers are required to voluntarily disclose information about their incomes to their tax authorities. And therefore, monitoring of social media accounts by tax authorities goes against this trust and voluntary declaration of incomes by taxpayers. Two is that social media monitoring by KRA and other tax authorities goes against what we call freedom of expression through the Constitution, as well as other instruments like the international instruments, such as the Article 19 of the UN Human Rights Convention. For many social media users, their postings and communication through social media is just for fun and for keeping their friends informed about their activities and lives. And so, when KRA and other tax authorities start monitoring such social media accounts, it infringes the expression, the right of expression or the freedom of expression of such taxpayers. Three is that social media mining by tax authorities, including KRA, may or might punish those who cultivate false image of themselves in the social media or online. In some survey conducted in, by the British social media users, more than 75% of the people admitted that they were lying about themselves on social media. And that happens in Kenya and all over the world. Many people post information on social media which are not necessarily true about themselves. So today, for example, if I take photos in front of big mansions or big cars every single day and I keep changing them, if I post such on social media, that is not necessarily, may not necessarily be me. And so if KRA uses such information to determine or that to say that I'm not paying taxes as required, then that may not be true. I may end up being punished falsely just because I'm passing information on social media that may not be true about myself. So such as some of the arguments for and against the use of social media, or rather social media mining by KRA and other tax authorities across the world. That is part A of the question. The question is all theory, remember. So I move to part B of the question. It says, a delegation comprising government officials and entrepreneurs from a neighboring countries has visited your country, which is a beneficiary of the African Growth and Opportunity Act, AGOA, to learn more on AGOA and its benefits. A delegation comprising government officials and entrepreneurs from a neighboring country has visited your country, which is a beneficiary of the African Growth and Opportunity Act, AGOA, to learn more on AGOA and its benefits required. Prepare a brief to be presented to the delegation covering the following. Prepare a brief to be presented to the delegation covering the following. 1 is background information on AGOA. 2, conditions to be considered as an AGOA beneficiary country. And 3, trade benefits provided under AGOA. Now, this is a question on the topic economic integration. Now, economic integration, in short, is simply the grouping together of countries in a given geographical region for purposes of promoting trade among themselves. Now that reminds you to look deeply into trading blocks, especially the East African Community, COMESA, and so on and so forth. But this particular one is on AGOA, that is African Growth and Opportunity Act, AGOA. Now, this is the background information on AGOA. AGOA is a piece of legislation that was approved by the U.S. Congress on 18th May, the year 2000. AGOA is a piece of legislation that was approved by the U.S. Congress on 18th May 2000. The objective of this legislation is to assist economies of the sub-Saharan African countries to improve the economy and to improve the economic relations between the United States and the region. AGOA completed its initial period of validity, and that was in the year 2015. And therefore, it was extended on 29th June 2015 by a further 10 years to 2025. Now, each year, the U.S. President determines the eligible countries from the sub-Saharan Africa to be part of the AGOA. Then AGOA provides duty-free treatment to goods designated from such sub-Saharan African countries to promote the economic growth through governance and free trade. In other words, the aim of AGOA is to assist the sub-Saharan economies to grow and promote trade between that region and the United States. So the key points to note here is 1, the formation of AGOA. Number 2, the countries forming AGOA. And 3, the key objective of AGOA. So let me pick it again, as you may be noting. Number 1, I've said that AGOA is a piece of legislation that was formed and approved by the U.S. Congress on 18th May 2000. The objective of the legislation is to promote and assist the economies of sub-Saharan African countries and to improve their economic relations with the United States. Then AGOA completed its first 15-year period of validity in 2015 and was further extended by 10 years to end in 2025. Then each year, the U.S. President determines the eligible countries from the sub-Saharan Africa for the AGOA. Then how does AGOA benefit such countries? So lastly, I've said that AGOA provides duty-free treatment to goods of designated sub-Saharan African countries to promote economic growth through good governance and free markets. In other words, if such a country exports to the U.S., then the U.S. government will not be imposing duty, that is import duty, on such goods from such countries. And therefore, this will make these goods to be cheaper in the U.S., and therefore such countries will be able to export more and sell more, and therefore benefit more from such a trade. 2, still on that, is conditions to be considered as an AGOA beneficiary country. Remember, we have just mentioned in the first part that every year the U.S. President has the authority to determine which sub-Saharan African country joins AGOA. Now, you could say this in response to this. You say, AGOA authorizes the U.S. President to designate countries as eligible to receive the benefits of AGOA if they are determined to have established or are making continual progress towards establishing the following. In other words, the U.S. President looks at this for a country to qualify as a member of AGOA. 1 is market-based economies, that is, economies based on trade and economic growth. Number 2 is the rule of law. Such countries must be following the rule of law to the letter for purposes of promoting welfare of citizens in such countries. 3 is political pluralism, that is political inclusion, a case where every single citizen in such countries has the political right to do as they wish politically, of course within the limits. And 4 is elimination of barriers to the U.S. trade. That is, such a country must not be imposing any trade barriers between it and the US government. 3 is trade benefits provided under AGOA. That is, what does a country benefit to be, from being a member of AGOA? So you can say the following are the trade benefits provided under the African Growth and Opportunity Act. 1 is promotion of economic growth, of course, through trade or increased trade between the country and the US government. Number 2 is promotion of political reforms. Remember, one of the conditions to be met by a country to qualify as a member of AGOA is political pluralism and the rule of law. And so through AGOA agreement, there is promotion of political reforms in such sub-Saharan African states. 3 is improve U.S. economic relations in the region. Remember, one of the conditions, again, that must be met by a country to become a member of AGOA is elimination of any barriers to the U.S. trade. And so, by eliminating such trade barriers, such countries are able to have improved U.S. economic relations with themselves, which further promotes their economic well-being. That was part B of the question. Part C, still a theory, is saying alternative dispute resolution, ADR, is a method of handling tax disputes outside the judicial process. All applications for ADR should be through a suitability should go through a suitability test before the application is submitted for ADR. Let me pick that again. Alternative dispute resolution, ADR, is a method of handling tax disputes outside the judicial process. All applications for ADR should go through a suitability test before the application is submitted for ADR. Required: 1. Summarize the disputes that may not be suitable for the ADR mechanism. And 2. Describe the documents that must be submitted to support and facilitate the ADR discussions. Now, this is one of the emerging trends in taxation again, alternative dispute resolution mechanism. Now, as a measure to promote faster delivery of justice by the judicial system in Kenya, the government introduced what we call alternative dispute resolution mechanism, ADR. Now, this is basically any mechanism of solving or resolving tax disputes outside the normal court process, outside the normal legal process. So the question is, part A, summarize the disputes that may not be suitable for ADR mechanism for 3 marks. So you could say this, you could say the following are disputes that may not be suitable for the ADR mechanism. The following are disputes that may not be suitable for the ADR mechanism. This is as per the ADR framework in Kenya. 1 is disputes or suits which involve interest of the public or interest of several persons who are not parties before the court. In other words, ADR mechanism may not be applied in case a party to a dispute is not before the court. In other words, for ADR to be applicable, all the parties involved in such a dispute must be able to present themselves before the court. And if such a dispute involves the interest of the public, then such a dispute cannot be resolved through ADR. Number 2 is election disputes as to public offices. That is, disputes involving election issues that entail election of individuals to public offices, because that again is has public interest in it. And so any party, any dispute that involves or touches on the interest of the public cannot be resolved through ADR. 3 is proceedings which involve prosecution for criminal offenses. So criminal offenses cannot be resolved through ADR. In criminal offenses, it is the state that resolves the disputes, and so the individuals will have to go through the normal court process. 4 is special cases which involve protection of courts, such as claims against minors, deities, and mentally challenged. Remember, these are special groups which may not be able to participate effectively in the ADR process. So such special cases which involve protection of the minors, protection of the courts, such as claims against minors, deities, and mentally challenged, must go through the normal court process facilitated by the government itself. 5 is cases which are related to serious specific allegations of fraud, fabrication of documents, forgery, and even impersonation. So such cases or disputes must go through the normal court process or the normal legal process, and therefore ADR is not applicable in such cases as per the ADR framework in Kenya. Part 2, the same, is asking, describe the documents that must be submitted to support and facilitate the ADR discussions. Documents that must be submitted to facilitate and support the ADR discussions. One is a summary of the issues in the dispute. That is, the particular issues which are being disputed in that particular case. So then the parties involved in the dispute must present to the court a summary of such issues that are in dispute. Number 2 is the relevant assessments, of course, in this case by the legal system. 3 is a notice of objection and all documents submitted to the commissioner. If there is any party in the dispute that is objecting any of the issues presented in the dispute, then a notice of such an objection must be submitted to the process. 4 is the objection decision, that is the decision arrived at as a result of the objection. Another one is a settlement proposal with basis in the law as may be appropriate, if any. That is any proposal by the parties on how to settle the dispute before the ADR process. And lastly, any other documentation as may be required during the ADR discussions. The court may require or order the parties in the dispute to submit any further documentation. So in that case, such documentation become part of the requirement to process and facilitate the ADR process or mechanism. That answers question 1 of the December 2021 paper. Remember, in the current setting, I said question 1 is all theory, and in most cases it will test you on 2 or more topics at the same time. So be keen, especially on the issues of current trends in taxation and any other tax theory. That answers question 1.
Hello learners, welcome to our today's session of Revision Management Accounting December sitting. In our previous class, we were looking at question number 2, and today we are looking at question number 3 of the same sitting. So welcome, have your calculator. Let's walk through together. Question number 3, part A, reads as follows. The cost accountant of ABC Limited has provided the following information relating to production of a single product branded Z. So we've been given details for 3 periods. That's period 1, 2, and 3. We have production in kilograms, sales in kilograms, opening stock in kilograms, and closing stock in kilograms. Then additional information, note number 1, the financial details for 1 unit of Z based on the normal activity level of 30 kilograms are as follows. So we have the cost per unit for direct materials, labor, production overheads, and the selling price per unit. Then note number 3, we are told that administrative overheads are fixed at 25,000 per period, whereas 1/3 of production overheads are fixed. Then required, prepare operating statements using Roman 1 variable costing. So we want to begin from there. Roman number 1, variable costing. So in management accounting, we have 2 methods of costing that we use, and one is a variable, or what's called marginal costing, and then the other one is called absorption costing. So in variable costing or marginal costing, we normally include variable costs only in the cost of sales. So when we are computing the cost of sales, ensure that we are separating the fixed cost and the variable cost, so that we only consider the variable production cost. And that's what we are required to do. And since we have 3 periods, we need to show all the periods on one sheet. So we'll not prepare for period 1, 2, and 3 separately, but to show it as one statement. So you can prepare that. So this is ABC Limited variable costing income or operating statement. Variable costing operating statement. So we were not given the year. If we had at the year, then we say for the year ended, but we do not have that. So we all have that included. So we have period 1, period 2, and period 3. So for each period, we'll have 2 columns. So we have 3 periods, which will show it all together. And so we begin with the sales. So we normally have the format for preparing the operating statement. We'll have the sales, we less the cost of sales, we less the closing stock, the cost of sales, we less the fixed cost, and we'll be able to get the net profit. So we calculate the sales. We are beginning with the period 1. Period 1 sales were 30,000, and in note number 2, we are told that the selling price of product Z is 9 shillings per kilogram. So to calculate the sales, we are taking 30,000 multiplied by the selling price of 9, which will give us 270,000. And put in thousands of shillings so that we have smaller figures. So we have 270 as the sales for period 1. Then we less cost of sales. So cost of sales comprise the opening stock. When you look at the question, period number 1, we were told production was 30,000, sales was 30. And then we do not have any information about the beginning inventory. So we assume that there was no opening stock. So we just put a nil where we have opening stock. Then we add production cost. Production cost will comprise variable production cost only. So the main variable production cost as given in the question is, we have direct materials, we were told that it is 1.5 shillings per kilogram. So when we are calculating the variable costs, we base on production. So we take 1.5 multiplied by 30,000. 1.5 times 30,000 kilograms, and that will give us 45,000. We also have direct labor. We have direct labor, which was 1 shilling per kilogram, and production was 30. So 1 shilling multiplied by 30 will give us 30 shillings, 30,000 shillings. Then the next one is production overhead. Production overheads. So the production overheads that we are including are the variable production overheads only. In note number 3, we were told that the administrative overheads are fixed at 25,000 shillings per period, whereas 1/3 of production overheads are fixed. So meaning the 3/4 of the production overheads is variable. So we are to get that variable part, and that's what we will include in the cost of sales for that variable statement. So how do we calculate that? So working 1, we are calculating the variable production overheads, which is simply variable 2/3 of 3 shillings. A third is fixed, so means 2/3 is variable. So we multiply by 3 shillings, and this will give us 2 shillings. So to calculate the variable production overhead, this is our working number 1. Working number 1, we are taking 2 and we are multiplying by the production. So the production was 30,000 times 2, and that will give us 60. So we take 60, and then we add this. This gives us 135. Before we bring it here, this will give us 135, and this is the cost of goods available for sale. Then we less closing stock. So we were told that production was 30,000, sales were 30,000, meaning there was no closing stock. So we have nil stock, and therefore the amount will simply be 130, which is our cost of sales, and then we subtract it from the sales to give us what we refer to as contribution. So contribution is simply sales minus the cost of sales. So when you subtract this, you'll get 135, and once we get the contribution, we less all the fixed costs. So in variable costing, whether it is a production fixed cost or a non-production fixed cost, we subtract it from the contribution. So we are to identify the fixed cost in the question, and we'll calculate the fixed. This is 2 fixed production overheads. which we were told that was 1/3 of that which was given, and this is simply 1 shilling. So we have fixed cost under which we have production overheads, and this is 1 multiplied by the production. Production was 30,000 multiplied by 1, and that will simply give us 30,000. We also have administrative overheads, fixed administrative. The administrative overheads are fixed at 25. So you add that, this will give us 55, and we subtract it so that we get the net profit. So the net profit will be 80. That's for period 1. We do the same for period 2 and 3. We do the same for period 2 and 3. So for period 2, the sales, we need to calculate the sales, which we are basing on the sales in kilograms times the selling price. So the sales in kilograms were 27,000 multiplied by 9 shillings. So this will give us 243,000. Then we are lessing the cost of sales under which we have opening stock. So we need to know whether there is opening stock. In period number 2, the production was 38,000. The sales were 27,000. So when you take 38,000, remember we do not have any closing stock from period 1. So when we have closing stock in period 1, this closing stock will automatically be the opening stock in the next period. So that simply means in period 2, we do not have opening stock. Why? We do not have closing stock from period 1. So for opening stock in period 2, we also put a 0. And I was explaining we had 38,000 units produced, and we are told that 27 were sold, and then we have 11,000 remaining in stock, meaning there was no opening stock. From there, we add production cost. So production cost comprises direct materials. We are including variable cost only. So direct materials for period 2, we are taking 1.5 shillings. That was the cost per unit, and we multiply by production of 38,000. And this will give us 57,000 shillings. Then direct labor is given at 1 shilling per kilogram. So we take 1 multiplied by production of 38. 1 times 38, we will have 38,000. And then production overheads for period 2, we were told that variable production were 2/3. Still working number 1, 2/3, which gave us 2 shillings per kilograms. So 2 shillings multiplied by 38,000. 2 times 38,000 will give us 76. And then we add. So the total is 171. And in period number 2, we are told that we have closing stock of 11,000. So we need to calculate the closing stock value. This is working number 3, closing stock. Closing stock, this will simply be based on variable cost only. So we were told that closing stock, that is for period 2. Period 2. We have 11,000 units times. So the question is, what is the cost per unit? The question per unit, the cost per unit will comprise the cost per unit of direct material, the cost per unit of direct labor, and the cost per unit of production overheads, which we've already been given in the question. So we are taking 1.5, which is the cost per unit for direct materials, plus 1, this is 1.5, plus 1, that's the cost for direct labor, plus 2, which is the cost for production overheads. And what we get will be the value that we will use in period 2. So 1.5 plus 1 plus 2 will give us 4.5 times 11,000, and this is 49,500. So our closing stock here is 49.5. Subtract that. And this will give us 121.5. So 121.5 is the cost of sales, which we subtract from the sales. And this will give us 121.5. Then we come to fixed costs. The fixed costs, we say that was 1/3. Fixed production overheads, 1/3 of 3 shillings, which is 1. So we take 1 and then we multiply by the production. And production for period 2 is 38. So the fixed production overhead here is 38,000, and fixed administrative overhead remains fixed at 25. So add that, and this will give us 63. We subtract it from the contribution, and we'll get a profit of 58,500. That's for period 2. Then we move on to period 3. In period 2, we had closing stock of 49.5. So this closing stock will automatically become the opening stock for this period. So for opening stock, we have 40. Sorry, we've not calculated the sales. We begin from sales. So the sales for period 3, according to the question, production was 27,000 and sales were 38. So take 38,000 times the selling price of 9 shillings, which will give us 342,000. And then we less cost of sales, of which we have the opening stock. So the opening stock is here. Here is 49.5. This is the balance to be carried forward, which was 49.5. So we bring it there. Then we add production cost, and production cost is comprising direct materials. And the direct material cost per unit is 1.5, but production was 27. So take 1.5 times 27,000, it will give you the cost for direct material, which is 40.5. That's 40,500. Then direct labor is 1 shilling per kilogram. Production was 27. So 1 times 27,000 will give you 27,000. We come to production overheads, working number 1. It was 2/3 of 3, which is 2. We take 2, we multiply by production, which was 27. So 27 times 2 will give us 54,000. And then we add that. So this will be equal to 171. Then 171, we see whether there is closing stock. In the question, we do not have opening stock. Production was 27,000. The sales were 38,000. So when you take the sales of 38,000 and then you subtract it from the 27,000 production, you'll realize that there was a deficit of 11, which was just the balance that was carried forward from the closing stock. So there is no closing stock in period 3. So we subtract a 0, we subtract a 0, which will give us 171. We subtract 171 from the sales, and it will give us 171. Then we less the production overheads. Production overhead, working number 2, production overheads, working number 2. Working number 2, we have 1 shilling times production of 27, and this will give us 27. Then administrative overheads are fixed at 25. So we add that, and this will give us 52 shillings, which we then subtract from 171 to get a net profit of 119. And that's how we use variable. So a point to remember, in variable, we are including variable production cost only. When we compute inventories or stocks, we use variable production cost per unit only. We don't include any fixed portion. And that was Roman 1. Then we move on to Roman number 2. So Roman 2, we use absorption costing. So the company is ABC Limited. So we begin with the sales. So how is absorption costing different from marginal costing? We have 3 main things that differentiate between marginal and absorption. In marginal, we have said we are separating fixed cost and variable cost, so that what is included in the cost of sales is only variable. In absorption costing, the cost of sales will comprise both fixed and variable components. So long as it is a production cost, we consider it both as fixed and variable. Again, in absorption costing, we have what we refer to as product cost and period cost. Product costs are treated, in absorption costing, we treat fixed costs as product costs. But in marginal costing or variable costing, we are treating fixed costs as period cost. We expense them when they are incurred and in that period in which they are incurred. And the last item that differentiates between variable and absorption, in variable, we do not have application of absorption of overheads. But in absorption costing, we have application of the principles of absorbing cost, which is making it different. So we begin with the sales. The sales are calculated in the same way. So for period number 1, we have sales of 30,000 and the selling price is 9. So when you take 9 and multiply by 30,000, we get 270. Then we less cost of sales. So the cost of sales will comprise opening stock. So we didn't have opening stock in period 1, so we put a 0. Then we add production cost. Production cost consists of direct materials. So the direct materials for period number 1 is 30 times 1.5, which gave us 45,000. We add direct labor, and direct labor was 1 shilling per kilogram, and we had production of 30, which is 1 times 30, and that's 30. Then production overheads. So when we come to production overheads, we are not separating fixed and variable. In the question, we were told that production overheads was 300% of labor, and that the amount is 3. And in note number 3, we were told that administrative overheads are fixed at 25,000 per period, whereas a third of production overheads were fixed. So in marginal or variable, we were separating that. But in absorption, we don't separate. Why? So long as it's a production cost, whether fixed or variable, we include it in the cost of sales. And therefore, to calculate production overhead, we are simply taking 3 and we multiply by the production, which is 3 times, this is workings, 1. We are taking, this is production overheads. This will simply be 3 shillings times 30,000 kilograms, and that will give us 90,000. So we will have 90,000 and not 60 as in the case of variable. Then we add so we have 165. We have 165, which is the cost of goods available for sale. Then we less closing stock. Closing stock in absorption costing is based again on both fixed and variable, but according to the question, there was no opening stock. So there was no closing stock, so it is 0. We subtract that and we get 165, which is the cost of sales. When we subtract, we now get what we refer to as gross profit and not contribution. So the gross profit will be 105, and once we get the gross profit, we will consider whether there is any over or under. So we add over absorption. Over absorption arises when what we absorb or what we charge is more than what is actually incurred. So when you read note number 1, we were told that the financial details of one unit of product Z based on a normal activity level of 30,000 kilograms. So it means the details we have were based on the activity level of 30,000. So whenever a company produces either more or less than that, it means there will be either an over or under absorption. But in period number 1, we will not have an over or under. Why? This farm produced 30,000, which is equal to the normal level of activity. So for over absorption, there is a nil, and then under absorption will also give us a nil. So this is subtracted. Over absorption is added, under absorption is subtracted to give us the adjusted gross profit. So our adjusted gross profit is 105, and from there we less all the expenses. So in management accounting, expenses are simply referring to all the non-manufacturing costs. Any non-manufacturing cost is considered as an expense. So according to the question, in note number 3, we were told that administrative overheads are fixed at 25,000. So our expenses here are simply the administrative overheads, and is fixed at 25. So you subtract that, and what we get will be the profit, which is 80,000. That was for period 1. We do the same for period 2. The sales remains the same. Sales made were 27,000. 27,000 times 9 gave us 243. Then opening stock, since we do not have closing stock in period 1, opening stock is not will not be there. We add production cost, which is comprising direct materials. So direct materials were 38 times 1.5, which gave us 57. Direct labor was 38,000 times 1, which gave us 38. And then we need to calculate production overheads. This is working number 2. So production overheads was working number 1, and then still working number 1, production overheads. Now for period 2, we are using the same formula. We are simply taking 3 multiplied by the production units, in this case, which were 38,000 kilograms. So 3 times 38,000 will give us 114. So production here will be 114. And then we add. This will give us a total of 209. So something to note is the production overhead is 114, and the production was more than that of the normal activity level. We were told that this data provided is based on the level of 30,000. And so if we were to rate the actual amount should have been 90,000, which is based on the activity level of 30,000. But now here we have 114,000, which is above that. So it means that we will have an over-absorption. Why? What we are absorbing, or what we are charging, the 114 is greater than what should have been charged under the normal, which is 90. So when we are absorbing more than that which is actual, then we have an over-absorption. Of how much? Of simply the difference. So we show the over-absorption of overheads, which will be equal to 114,000 minus that of the actual activity, which is 90,000. So this difference and this will be 24,000. So we will adjust that on our profit. So we now have the cost of goods sold, which is 209. Then we see if there is any opening closing stock. We were told that closing stock was 11,000. So how do we calculate closing stock? So closing stock will be based on all the production cost, both fixed and variable. And so in this case, closing stock will now be 11,000 multiplied by the cost of direct material plus that of labor plus that of the production, both fixed and variable. So when you calculate that, this will give us 60,500. So the closing stock will be 60,500. This will be 60,500. We subtract that and then we get the cost of sales, which is 148.5. Subtract the cost of sales from the sales to get gross profit of 94.5 or 94,500. Then we check if there was an over-absorption. There was an over-absorption of 24,000. So we add 24,000. There was no under-absorption. And then we get the adjusted profit. So this will give us 118.5. Then we less expenses, which are just the 25,000. Then this will give us a profit of 93.5. 93.5. We move on to the last period. That's period number 3. The sales are remaining the same. That is 342. Then we add, we less cost of sales, of which we have opening stock. So in period 3, we will have opening stock. Why? Because we had closing stock in period 2. So opening stock will be 60.5. Then we add production cost, which is comprising direct materials. The direct materials is production 27,000 times 1.5. Which gave us 40.5 or 40,500. Then we add direct labor, that's 1 shilling times 27, and that gave 27. And then we calculate production overheads. So production overheads for period 3. Period 3 production overhead. Period 3 production overheads. This will be equal to 3 shillings times 27,000. And this will amount to 81. So for the normal activity level of 30, the production overheads were 90. So the actual production overheads are 90, but now what we are absorbing is less than that which is actual. So when the absorbed is less than the actual, it means that we have an under absorption of overheads. And under absorption is the difference, which is 90,000 minus 81,000. So this will give us 9,000 shillings. So we will use that again to adjust our gross profit. So we add this. This will give us 128. There was no closing stock in period 3. So we have nil closing stock. And so we'll have 128 cost of sales. We subtract the cost of sales from the sales. And this will give us 214,000. So we do not have over absorption, but we have an under absorption of 9,000, which we subtract, and then we remain with 205,000. So 205 less expenses of 25,000 will remain with, so the profit will be 180,000. And that was part A of question number 3. We now move on to part B of the same question. Summarize 4 assumptions of cost, volume, profit analysis. Assumptions of cost, volume, profit analysis. So cost, volume, profit analysis is comprising 3 variables. We have one variable, cost, another one is volume, and the other one is profit. So in cost volume analysis, we are looking at when one variable is changed, what will happen to the other variable? Are fixed costs remaining constant? What will be the effect on the revenue, and so on? So what are the assumptions? Assumption number 1, we say that total costs can be separated into their fixed and variable components. This is question 2, part B. 2, volume is the only factor affecting sales and expenses. Number 3, the theory of cost, volume, profit analysis. The theory of cost, volume, profit analysis applies to only a single product. Applies to a single product, only applies to a single product or service only. Then number 4, the selling price per unit, variable cost per unit, and fixed cost remains constant. You can add one. There is only a single product, there is only a single product or service there is only a single product or service, and in case of more than one, then a product mix will be applied. So those are some of the assumptions of cost volume profit analysis. Number one, we are saying that total costs can be separated into their fixed and variable components. So whenever you are given a total cost, we normally say that total cost equals fixed costs plus variable cost, so that given a total cost and a proportion of either fixed or variable, we can be able to separate them. Then two, volume is the only factor that is affecting sales and expenses. So when we change, we assume that in a cost volume profit analysis, whenever we change volume, there will be a change in sales that will bring about a change in expenses. So we say that the only factor that is affecting either sales or expenses is volume, and that happens when volume is changed, whether either being increased or decreased. And then the theory of cost volume profit analysis applies to a single product or service only. So it is not applied where we have more than one product. So in the last part, we have said that if there is only one product, we are assuming that cost volume is being applied where we only have one product or service. And in case we have more than one product, then we must have a product mix being applied, but it cannot be applied where there is more than one product. And again, we assume that the selling price per unit, the variable cost per unit, and fixed cost per unit remain constant. And we assume from 0 capacity to 100, especially in the case of fixed costs, they do not change. That was part B. Then lastly, we move on to part C. We are told that Britain Limited makes a single product branded P with a sales price of 100 shillings and a variable cost of 60 shillings, full stop. Fixed costs are 600,000 per annum. They are required, assuming the taxation rate is 40%, determine the number of units to be sold to make a profit after tax of 200,000 shillings per year. So assuming taxation, you have to ask yourself, what are you being asked to calculate? You are simply being asked to calculate in Roman 1, part C, Roman 1, you are being asked to calculate the level of sales to realize a target profit after tax, and that is in units. Level of sales to realize a target profit of after tax. So you've already been given the target profit, you have the tax. So how do we calculate this? This is the formula that we will use. We will have fixed costs plus target profit, and this target profit is to be exposed to tax. So we take 1 minus tax, or T, and then we divide the whole of this by CM. CM is simply contribution margin. So we calculate that. We were told that the annual fixed costs are 600,000 plus the target profit assumed is 200,000. We divide this by 1 minus tax, and the tax rate given is 40%, which is the same as 0.4. We divide the whole of this by contribution margin, and contribution margin is simply the sales price, which is 100 shillings minus minus the variable cost per unit of 60 shillings. So we normally refer to this as CM, which is simply the selling price per unit minus the variable cost per unit. So we calculate this. So this will give us 23,333 units. So that's the level of sales that you will need to sell for you to realize a target profit of 200,000. Then Roman 2, we are told that as a result of increasing costs, the variable cost is expected to rise to 65. So it is rising from 60 to 65 shillings per unit, and the fixed cost to 700,000 shillings per annum. So we are told that assuming the selling price cannot be increased, determine the number of units required to maintain a profit of 200,000 shillings per annum. So we are told to ignore inflation. So in other words, we are to calculate, determine the level of sales to realize a target profit. Just the level of sales to realize a target profit. So how do we calculate this? This is simply equal to fixed costs plus target profit, and then we divide the whole of this by contribution margin. So the fixed costs, we are told that the fixed costs are increasing to 700,000 plus the target profit of 200,000. Then we divide the whole of this by CM, and the CM is changing. So we are told that the selling price is remaining constant, but variable costs are rising to 65. So what will be the sales? So this will be 25,714 units. And that's all about question number 3. So to give a summary of question number 3, you are to read more on marginal and absorption costing and application of break-even point in decision making. And so when we are calculating the break-even point, be able to know how to calculate the break-even point in different situations. When there is tax, when there is no tax, when there is a target profit, when there is no target profit, and the mathematical formula that are applied in all those situations. So that brings us to the end of our question number 3, and let's meet in the next session.
Hello learner, welcome to Manifested e-learning platform. My name is Emily Ngwiri, and today, ladies and gentlemen, we are discussing business and data analytics. The focus is on December 2022, question 24. The question reads as follows. Bermuda Limited has presented the following information for the purpose of preparing a statement of cash flows. So you are provided with an extract of the statement of profit and loss for the year ended June 2022 with the following subheadings: the revenue, the cost of sales, the gross profit, gain on financial asset at fair value, the investment income. Then you're also provided with the expenses, other expenses, administration expenses, distribution costs, finance cost, profit before tax, income tax expense, profit for the year. You're also given an extract of the statement of financial position, the assets being as follows: the non-current assets, property, plant and equipment, PPE, intangible assets, financial assets at OCI, then the current assets, inventory given as trade receivables, financial asset at fair value, cash and cash equivalents. You're given the total assets. You're given now the section that relates to equity and liabilities, ordinary share capital, 10 each, share premium, revaluation reserve, financial asset at OCI, that is the equity reserve, the retained earnings, the retained profit. You're given the non-current assets, 10% convertible loan stock. The current liabilities are given: bank overdraft, the trade payables, the interest payable, income tax expense, total liabilities, and you're given the total capital and liabilities, or total equity and liabilities. Additional information. Number 1, property, plant and equipment. The property, plant and equipment, or PPE, held by Bermuda Limited are items of plant and equipment and freehold premises. During the year ended 30th June 2022, items of plant and equipment which originally cost 40 million shillings were disposed of, resulting in loss of 6 million charged in administrative expenses. These items had a net book value of 28 million as at the date of disposal. Number 2, depreciation charge for the year was 43 million. Number 3, 50 million shillings of convertible loan stock were converted to 50 million ordinary share capital at par. You are required to prepare statement of cash flows for Bermuda Limited for the year ended 30th June 2022 as per IAS 7 cash flow statement. So I'll be able to just walk you through the steps, the requisite steps that are going to enable us achieve our objective of the cash flow statement. But as you can see over here, the word stock wasn't written properly over here, so we just make a small adjustment over here. Stock, sorry, that's in caps. Stock were converted to 50 million ordinary shares per share capital there. So we've adjusted that, and we can begin with our solution, which is on the right of your screen. So the first step, ladies and gentlemen, is to compute or have some side workings based on the financial asset at fair valuation. So we are going to have items listed, and then you'll be able to now have the changes being the description of the figures being given on this. So we'll first of all begin with balance brought forward. So brought forward, CF, like that. So we begin with financial asset at fair value, right over here. So financial asset at fair value, that. So don't worry even if it crosses like that. So I'll just double click right here, and it will be able to give us a space over here. If you prefer it not to have any space over here, you just delete that space like that, so that you can be able to have the values close to the narrative over here. So we can pick over here or we can be able to also insert over here, because we're dealing with shillings. An accountant is supposed to have at least proper values given properly over here in terms of the given currencies. So shillings, and also in terms of thousands, millions, billions. So we need to provide that for completeness sake. So shillings, and we're saying that it is in millions. So we can put M like that. You can see it's over here, shillings in millions over here. So we need to honestly do the same over here. Shillings, caps, millions, like that. So we put it in small letters like that for consistency. That bring it close to each other over here, or we can just decide, we just delete that and then plus that there, and it will just pick, and we drag that. Remember that plus sign, guys, it has to be plus like that, not plus like this. It has to be plus like that. Black, you just drag it like that. So financial asset at fair value, we can pick these values that have been given from the balance sheet over there. So we can check from the statement of financial position right over here, financial asset at fair value. We can see over here financial asset, as we just scroll down over here, 1 second. That means that we need to actually get it from the balance sheet right there. So just 1 second as I try and trace it over here. Oh, it's actually under current assets. I hadn't seen it. I was just really trying to take my time. So it's under current assets over here. Financial asset is right here. Yes, you can see it. You can see here. So we are going to indicate the values there. So balance brought forward, we have 30 over here. So we pick it because we are using Excel plus. We do not want to cook and just put our figures over here, because I can decide over here to put 30 over there like that, and then we can be able to also put over here as 65, because we've seen right over here current assets, this one, financial asset at fair value right over here. If it allow me to maybe just highlight it like that, I can decide to put 30 and 65 based on the figures, but because we are accountants, we need to properly relate or link the value. So plus, so you can put over here that one, enter, and then plus 65 there, enter that. So once we've done that, then we can be able to now proceed on to now incorporate the changes due to fair value gain over there. So changes due to fair value gain over there. And why we are creating a space over here is because we want to also include it in terms of millions. So there's no need for us to actually indicate over here that it's millions, because going down over here is in millions. So we just copy this, just put them down there like that in millions. So as you can see, if you don't copy them properly, copy, paste special, guys. And what do you want to paste? You want to paste just the way the values are like that, or do you want to complete the formulas? We want to the format over here, or do you want to keep source formatting, so it give you like that? So we are interested in the values. You can see over here values there. So interested in the values, let it stay like that. So the changes due to fair value gain are given to us over here. You can check from the income statement of the balance sheet over there, changes due to fair value gain. You can see it here, actually. It's given to us over here, highlighted there. It's 5. So we put it as negative value there. We are following based on this statement over here, IAS 7 cash flow statement. So we are picking the value of 5 over here, and that is gotten from the revenue, from the income statement here. So plus, minus, because we want it as a negative value, that one there, put there, 5. Then cash and cash equivalents. And cash equivalents. So cash and cash equivalents, where do we get the values for cash and cash equivalents? From the balance sheet over here. So cash and cash equivalents, you can see them right over here, cash and cash equivalents right here. So we pick which one? We pick the most recent value. For 2022, we pick the 29 right over here. So you can pick that value there. If you allow me to use red to highlight that. So we pick the 29. So plus, so we go on to the balance sheet and pick the 29 right there. Enter. Here, we're going to put a 00 value. So 0. It means like that. Next, we're going to pick the bank overdraft. So bank overdraft. That. So pick the bank overdraft. We're going to pick it from the statement of financial position. So we just try and see from right over here, the bank overdraft. That should be current liabilities. You can see 22 over here. So we're picking 22, and that is what we're going to pick, 22 plus 22 right here. Bank overdraft is here. So once we pick that, for this other year over here, carried forward. So this has been brought forward from the previous year, because you're seeing, ladies and gentlemen, over here, the 22 bank overdraft here was from the previous year, 2021. So it has been brought forward to 2022. So I need to highlight that in red there. It's been brought forward. Then we now get the totals right there. So the total from the beginning is going to be plus sum. You can see sum over there. We're going to add from here, moving down. Close the bracket. 60. What I did was I put the cash equivalents. Remember what I did to the cash equivalents? I picked 29 over here, but the way I put it, or I put it as if it was 2021. So I should have put it on this other further end over here, because that would mix things up over here. So I just pick this over here like that. I just wait for the plus sign, not that plus sign. I'm looking for this sign that appears to black. I just put 29 right there like that, and here 0. I hope you've understood that. I can really explain it. So this one is going to be 2021. Allow me to put 2021 so that I cannot be able to mix myself up. 2022 like that. I think that seems to be better, or I can be able just to insert this moving down. Down. You can see down, the option down, it gives me down like that, and this one should also move down. Cut, Control V. 2021, 2022. So bold. So if this is 2022, we got 29, and that's where we put the 2029 over here. It is 22 over there. Remember the 65 over here, financial asset fair value, 65, we put it under 2022. So it was me who did an error. Apologies for that. So the bank overdraft over here changes the cash and cash equivalents is that the bank overdraft is given to us there. The bank overdraft should be 22, and here we are saying it's not be the sum. Here should be 00, because you're saying the bank overdraft for 2021 was 22, and which we've gotten right over here, 22. You can see the 22 relates to the year 2021. Right above over here, so that is 0. So now we're going to get the totals over here. Total. So this should be bolded. That, and we can say we're just going to get plus sum will give you a prompt. You click the first one, not sum if. That we go from there to down over there, and then we close the bracket. Enter. We get that as the total. We can drag this. We don't have to now do the same, because once we put the formula over here, we just drag it moving backwards like that. So this bank overdraft, ladies and gentlemen, should it be positive or negative? A bank overdraft should indicate that we owe individuals. So it should be plus minus like that. So plus minus. So this should be a negative value. So we can now do the format, yeah, like that. So we just put formatting. We click on this one that has got brackets like this if you want this to be in brackets, and then you select format painter. That this is now, of course, just presentation and all. We don't have to underline this over here. We just remove the underline there. So this one is negative, that's negative. So negative and so on and so forth. So once we have that, we can then move on to get workings on purchase of PPE. So purchase of PPE, put workings on purchase of PPE. So workings, purchase of capital PPE, property, plant and equipment. So we'll still go by this, will be our guide, 2021 and 2022. So we begin by analyzing the balance at the beginning of PPE. Working, spelling. Working, I-N-G, working of purchase property PPE. So put that as bold. So our first talking point over here is the balance at the beginning. Balance at the beginning, we're dealing with 2022. So the balance at the beginning, we should be able to get from the balance sheet. You can see this is the 264. It was balance at the beginning over here. So we select plus that value. Why are we putting it under 2022? We're putting it under 2022 because the closing balance over here, becomes the opening balance in this year. So balance at the beginning of 2022 was that one. Place it down over here because we're not dealing with the working, it's down over here. Then we move ahead and assess the loss, revaluation loss, if there was any loss. Revaluation loss. So we are not interested in giving it when it's bolded. Like that. So the revaluation loss would mean that we'd have to go to the balance sheet. So we just get the statement of the equity and liabilities section because we have the revaluation reserve here. So for us to get the revaluation loss, we'll have to get the difference between this one and that value there. So it begins by getting, we begin by getting the 2022 value over here, 67 minus the 36 over there. So plus, move up over here, plus 67. We are not going to put the figures. I'm just going to go over here, 67, because you're dealing with revaluation reserve, minus 36. Click there. That. Get 31. And so we need to highlight that, revaluation reserve. The permission. I hope it's not too bright, guys. So once we've done the revaluation loss, the difference, the revaluation reserves is amount of money that is kept in a revaluation account, so that if you want to finance any future expansion, or you want to maybe issue additional shares, then you can be able to do so using, of course, resources from this revaluation reserve. So that's revaluation loss. Once we have that, we move on to get the net book value on disposal. Net book value on disposal. Value on disposal. So the net book value on disposal we get it from the balance sheet. So the net book value on disposal, we should be able to try and get it from over here, from the balance sheet over here. Net book value on disposal, we can see it under the additional information. Property, plant and equipment. This is information that relates to PPE. PPE, property, plant and equipment, held by Bermuda Limited are items of property and equipment and freehold premises. During the year ended 30th June 2022, items of plant and equipment which originally cost at 40 million were disposed of, resulting in a loss of 6 million charged in administrative expenses. These items had a net book value of 28 million. So this is the 28 million that we're going to use over here. We're going to use it as a negative value. So negative. So I cannot be able to use it directly over here because it's in continuous prose over here. So just allow me to use it to hard code it and key it in like that. So we need it to be similar format there as this one here. Then we assess depreciation. Depreciation. So depreciation, we can be able to get it. Let's check the additional information over here. Number 2, depreciation charge for the year was 43 million. So depreciation, we include the 43 million as a negative value. Like that. So we just use format painter. Let's move along. So once we've done that, this also needs to be a negative because we're talking about a revaluation loss. So revaluation losses are given negative values, or is represented as a negative value. So you put negative there, then we open the bracket there like that and close the bracket there like that. So gives us minus 31. So format painter again like that. Once we've done depreciation, we need then to get the purchase of new asset over here. So purchase of new asset over here. So we don't have the value of the purchase of the new asset over here, but we already know what the balance of the PPE is. So the balance of PPE, or balance of property, plant and equipment. Pardon me for that. Balance of PPE. So the balance of PPE, with your permission, I'll just bold it like that. Or if I bold it, it will mean that it is a subheading over here. So let me not, let me just undo that. So this value over here, I can put the totals as like so, double underline like that. You can also do that for these values here. So you double underline that to represent that those are totals. Will be the balance of PPE over here. So the ending balance of PPE, we can be able to see clearly it's right over here. So plus that value there. The purchase of new asset will be the difference between 327 and these totals over here. So I'll insert a formula over here, plus 327 minus, open the brackets, the sum of the beginning balance at the beginning through to depreciation there. sum, there like that, put it like that, then we close the brackets and we say, okay, there's another bracket that I need to close because we're saying we have two brackets. So there's this opening bracket, so there are two brackets that need to close like that, and those are just function arguments, 165. So this should be the purchase of the new asset there. We need to have these workings over here because these workings will be contributory towards the preparation of the statement of cash flows based on IAS 7. So once we've done the working of purchase of PPE, we move ahead and now analyze the share capital component, which represents the final working before we prepare the final statement of cash flows. So we can say here, balance at the beginning. So I skip over here. So balance at the beginning. Balance at the beginning. What are we talking about balance at the beginning? We're talking about share capital over here. So share capital. Pardon me. Once we have share capital over here, what are we talking about? We're talking about millions. So we just copy these values, copy. And what did we say above there? Paste special. If you paste, ladies and gentlemen, let's just do what we did. It will not give you exactly what you want. So we just come and undo like that, paste special. Paste special, and we want values. It gives you that. So then you can escape like that. Now we can say share capital relates to that part there. And you're also talking about share premium, if any, share premium. Over here. And then we have now the total value right here. Total value given to us there. And these are in millions. So we just do the same right here, in millions. So what is the balance at the beginning right there? So the balance at the beginning given to us there is, let's see, down here. We can just come, we can see note number 3. Shillings 50 million of convertible loan stock were converted to 50 million ordinary share capital at par. So that does not relate to that. Pardon me for that. I'm just trying to. This is the part over here that I'm talking about. Balance at the beginning. Oh, this is convertible loan stock. That should not be the one over here. Just a second. This is the part that relates to share capital over here. Balance at the, yes, it's right here. It's right, this 150 here. Balance at the beginning, the 150. So we pick balance at the beginning share capital, 150, but we do not do that. Pick plus the 150. I just seen it just now. We pick that. Enter. Then there is nothing to do with share premium. 0. Then the total should be given as plus that value there. Enter. Then we talk about conversion of loan stock. Conversion of loan stock. Spelling conversion. Loan stock. We have some information given to us there at the additional information. That is what I had initially read, thinking that that was the beginning, balance at the beginning. So 50 million convertible loan stock were converted to 50 million ordinary shares. So conversion of loan stock, how much? Just put 50 there plus 50. So the 50 does not represent any figure, it's continuous prose, so we just put 50. That. Do we have share premium for that? No. So we put 0 there, and then we just drag the formula here. Remember that plus sign? We drag it like that. Conversion of loan stock, after that, we try and assess the changes over here, changes. Over here, so we put 2 lines that go like so. So we come over here. So we try and assess the bottom border, and you can be able to put the top border like that. What is the effect? It gives us just that line like that. So the changes is plus that one plus that one. We get 200. And we just drag the formula like that. So it will always speak like that, so we just drag it like that. Here there is nothing. So you can be able to just put the comma format, come to comma, or we can be able to, you press Alt H. Now the comma format, you can see K, where the comma is, K. So what happens is that it puts dashes like that for items that don't exist there. So here we just put the same, the comma format, just click it like that, just for presentations purposes. So once we have that, then we can proceed on to identify the ending balances. Ending balance. Yeah. So the ending balance, right over here, we assess the ending balances right over here from the expenses. We can see them here. The 230 was the current, is the most recent over here. So we pick plus, go all the way here like that, down. 230. Enter. Once we pick the 230, the share premium, was there anything to do with share premium? You can see just beside it, right here. So plus, just come down here, share premium, enter. It didn't pick, so plus, I think it didn't pick. You can just come directly there, enter. And then we get the total over here. So remember, the total will be given based on whatever I've already calculated, but not in this format over here above, but we're saying, but it will just be plus that value. So that will be the ending balance. So what is the increase due to the new issue? Increase due to the new, of course, the new conversion of loan stock, the new issue. Over there, we can see we'll just subtract upwards, so plus that value minus 200, enter. Here we just pick the formulas right here, that plus sign like that, 60. So that is the increase due to the new issue over there. Now, ladies and gentlemen, the moment of truth has arrived. We now prepare a statement of cash flows based on IAS 7. So with your permission, once we have these values over here, I can just start over here, scroll down here. Cash flows from operating activities. From operating activities. I'll bolden that. So we are interested in the statement of cash flows. So it's always good to write statement of cash flows for the year ended 30th June 2022 before we just go directly to write the cash flow from operating activities. prudent as an accountant. So Bermuda Limited statement of cash flows, for the year ended 30th June 2022. That. So maybe you could decide to merge the cells so that now, at least for presentation purposes, so you come over here, merge cells, merge and center. So that now it can indicate that now it's the entire, whatever side workings we have over here, at least it relates to Bermuda Limited. So cash flow from operating activities. We can be able to put now shillings, millions over here. So in a similar format over here, you can just do it something like this. Copy, paste special, values. There. So we start off based on IAS 7, profit before tax. So profit before tax, we pick it plus this one. You can see it over here. This is the value over here. We're talking about statement of profit and loss. It's 114. So we pick that, enter, and then we proceed on to do the adjustments for non-cash incomes and expenses.
Hi candidate, welcome to another session of Manifested Online Classes. So in this particular session, I want us to look on an illustration question on analysis of financial statement. And the question I want us to go through is the question which was tested in the sitting of August of 2022, specifically question number 5B. So the question reads, Dragon Limited is a public entity which has grown in recent years by acquiring established business entities. The directors of Dragon Limited have identified two potential entities targeted for a takeover. The directors believe that shareholders of the two target company would be recipient to a takeover. As a prerequisite to the takeover decision, the directors have tasked a firm of consultants to carry out cross-sectional analysis of the financial statement of the potential target companies which operate in the same industry sector. The financial statements of two entities as at 30th April 2022 are shown below. We have the statement of profit or loss for the year which ended 30th of April 2022 for two companies, Able Limited and Cedar Limited. We have revenue, cost of sales, gross profit, distribution cost, admin expenses, operating profit, finance cost, profit before tax, income tax expense, and then we have the profit for the year. We also have the statement of financial position as at 30th of April 2022 for Able and Cedar Limited. We have the non-current asset which include property, owned plant, right of use asset. At the current asset we have inventory, trade receivables, bank total assets, and then we have equity which comprises of ordinary share capital, evaluation reserve, retained earnings, and then we have the total equity. At the non-current liabilities we have the lease liability, 10% loan notes, and then we have current liabilities which comprises of trade payables, lease liability, current tax, and then we have the total equity and liabilities. What is required in Roman 1 of that question is common size statement of profit or loss for the two entities for the year which ended 30th April 2022. Roman 2 common size statement of financial position as at 30th April 2022. And finally, we are required to advise the directors of Dragon Limited on the best company for the takeover. So let's start with the Roman 2, sorry, Roman 1 of that particular question, whereby the examiner was requiring we prepare common size statement of profit or loss, statement of profit or loss for the two entities, which is for the year which ended 30th of April 2022. Remember, when talk about the common size, a statement of profit or loss, this is prepared by expressing all items in the income statement or the statement of profit or loss as a percentage of total asset. So not the total asset, but rather the revenue or the total what? Revenue. We are going to express all items as a percentage of the revenue. And take into account we have two companies. We have two companies. We also need to have two columns here. The first column will be for the company which is called Able Limited, and the other one will be for the company which is called Cedar. So what we do, we express all those items in the income statement as a percentage of revenue. So revenue as a percentage of itself is always 100%. This one is 100% because what we do, we take the revenue, for example, for Able, 87,500, then the denominator here will be the revenue. So 87,500 times what? Times 100, times 100. So that is always 100%. Then we have the cost of sales. So to express the cost of sales as a percentage of revenue, we take the cost of sales 66,500 divided that with the revenue for that company which is Able, 87,500 times 100. That is for the first company. For the other company which is Cedar, we are going to do the same. Take its cost of sales 114,800, divide that with the revenue for Cedar Limited times what? Times 100, times 100. So let's compute this. We see what we are going to get here. We see what we're going to have. So we have 66,500 divided by 87,500 times 100. That will give us 76%. 76%. What about the other company? Okay, so I think first of all we can deal with the Able, whereby we are going to express all items in the income statement of Able Limited as a percentage of what? Of revenue. So let's go to the gross profit. Gross profit. So the gross profit in this case is 21,000 divided by revenue 87,500 times 100. This will give us 24%. What about the other item, which is the distribution cost? Distribution costs. So the distribution cost is a figure of what? Is a figure of 1495 divided by 87,500 times 100%. That will give us 1.78%. Then we have the administrative expenses. The administrative expenses, which is 2880 divided by revenue 87,500 times 100, which will give us 3.29%. Then we have the operating profit. Operating profit. And I hope you can see what I'm doing here. We are expressing everything as a percentage of revenue. You don't have to underline anything. You don't have to put anything. You don't have to show anything as a negative. You just show, you express all those items as a percentage of revenue, as a percentage of the company's revenue. So we have the operating profit, which will be 1625 divided by 87,500 times 100. So that will give us 19%. Then below that we have the finance cost. Finance cost. The finance cost in our case is 875 divided by 87,500 times 100, which will give us 1%. This is 1%. Then below that we have the profit before tax, which is a figure of 15,750 divided by 87,500 times 100%. Times 100%, which will give us, okay, let's take that again. We have what? We have 15,750 divided by 87,500 times 100, which will give us 18%. Then we have the income tax. So for the income tax is 3150 divided by 87,500 times 100, which will give us 3.6. And finally we have the profit for the year. The profit for the year, 12,600 divided by 87,500 times 100. That will give us 14.4%. So we need to repeat the same process for the other company, that is Cedar. We express everything as a percentage of the revenue for Cedar. So we go to the cost of sales here, which is 114,800 divided that with revenue, which is 140 times 100. That will give us 82%. 82%. What about the gross profit? 25,200 divided by 140 times 100. This will give us 18%. Then we have the distribution, which is 2710 divided by 140 times 100, so which will give us 1.9%. Then below that we have the administrative expenses, 5340 divided by 140,000 times 100, which will give us 3.81%. Then from there we have the profit, the operating profit, 17,150 divided by 140,000 times 100, 12.25%. And then below that we have the finance costs, 3,150 divided by 140,000 times 100, which will give us 2.25%. Then we have the profit before tax, 14,000 divided by 140,000 times 100, which will give us 10%. Then we have the income tax, 3,500 divided by 140,000 times 100, which will give us 2.5%. And finally we have the profit for the year, 10,500 divided by 140,000, which is 7.5. So that is what we refer as the common size statement of profit or loss. It is also important to note that from this common size statement of profit or loss, there are a number of ratios which you have already computed here, and which you can use in terms of evaluating which company is performing better than the other. So the first ratio which you have computed is what we have here, this one. Because in computing this, what we have done, we have taken the gross profit all over revenue times 100, and therefore this is a gross profit margin. A gross profit margin. So you can use that to compare the profitability of two companies, and going with the gross profit margin, we can say this company is profitable than Able is profitable than Cedar. We also have this other ratio here, which we have computed by taking the operating profit or the profit before interest and tax all over revenue times 100. So this is what we refer as operating profit margin. So equally you can see, going with that, ratio, profitability ratio, we can see these companies more profitable than SIDA. And also we have this other other ratio here, where we have taken profit after tax all over revenue times 100. So this is what we refer as a net profit margin. And equally going with that, we can also see that this company here that is able is more profitable than what? SIDA. In fact, we can make that particular conclusion here that Able Limited, is more profitable than what? Than SIDA. Limited. Remember, this particular information will help us in terms of advising the management of this company, which is Dragon Limited, on which company to acquire. Remember, we are told that Dragon Limited is targeting to acquire either Able or SIDA. So if in this case we are advising the management based on or we are advising the management on which company to acquire based on their profitability, automatically we are going to advise them to acquire which company? This company that is Able, because you can see as per these three profitability ratios, this company is more profitable than what? Than SIDA. So let's move to Roman 2 of that particular question. And Roman 2, what the examiner was requiring is the common size statement of financial position. Common size statement of financial position. And this one is basically prepared by expressing all items in the statement of financial position as a percentage of the total asset. Equally, you have to remember that the common size, this is also known as the vertical analysis. The vertical analysis statement of financial position. Statement of financial position. So here what we need to do is to express all items here as a percentage of total asset. We equally need to have two columns. We have Able Limited, and then we have SIDA Limited. We are going to express all items as a percentage of total asset, as a percentage of total assets. So we start with the non-current assets. We have property. Then we have owned property or owned plant. We have right of use asset. Right of use assets. And then we have the current assets. So for the current asset, we have inventory. We have trade receivables. Then we have bank. And then total assets. Total assets. So basically, total asset, because we have to express everything here as a percentage of total asset. Once we express total asset as a percentage of itself, that automatically give us 100 what? 100%. 100%. 100%. So we're going to compute all these particular items as a percentage of total asset. And then below that we have equity. Equity, we have ordinary share capital. We have retained. Okay, before that we have revaluation surplus. Revaluation surplus. We have retained earnings. Retained earnings, and then we have the total equity. Okay, so we can just ignore that. And then we have non-current liabilities, where we have the lease liability. And then we have 10% loan notes, 10% loan notes. And then from there we have current liabilities. We have current liabilities. For current liabilities, we have three. We have trade payables. We have lease liability, and then finally we have current tax, and then we have the total equity and liabilities. Total equity and liabilities, and equally here, total equity and liabilities, this is the same with the total asset, and therefore once we express this as a percentage of total asset, automatically it will give us what? It will give us 100%. So therefore what we need to do, we need to express all these items in the statement of financial position as a percentage of total asset. So let's start with the property, and we start by doing that for the first company, which is Able. So we have 9,800 divided that with the total asset. Total asset as given as 33,600 times 100, which will give us 29.2%. And then for the other company here, okay, for the other item we have 7,000 divided by 33,600, which will give us 20.8. This company was not having any right of use asset. What about current asset? We start with the inventory, 5,600 divided by 33,600, which will give us 16.7%. Receivables, we have 7350 divided by 33,600, which will give us 21.9%. And then we have the last item, which is not the last item, but the other item, which is 3850 divided by 33,600, which is 11.5. 11.5. So we need to do the same to the other items of equity and liabilities. Let's start with the ordinary share capital, 3,500 divided by 33,600, which will give us 10.4%. 0.4%, and then we have 1750, which is the revaluation surplus divided by 33,600, which will give us 5.2. Remember here we are expressing everything as a percentage of total asset. What about the retained earnings? 5,600 divided by 33,600, which will give us 16.7%. What about the risk liability? This company was not having a risk liability. The company only had the 10% loan notes, which is 15,750 divided by 33,600, which will give us 46.9. Then from there we have current liabilities. So we have trade payables 4375 divided by 33,600, which will give us 13.0%. No risk liability, and finally we have tax 2625 divided by 33,600, which will give us 7.8%. So basically what we have done here, we have expressed all items as a percentage of total asset. We need to repeat the same exercise, the same process for the other company, which is CEDA. We compute everything as a percentage of total asset. Let's start with the property, which is 10,500 divided that with the total asset 66,500. This will give us 15.9%. The owned plant 8050 divided by 66,500, which is 12.1%. And then we have the right of use asset 17,500 divided by 66,500, which is 26.3%. We go to current asset. We start with the inventory 11,900 divided by 66,500, which will give us 17.9. 17.9. Then from there we have 17, the other item of receivable, 17,850. 850 divided by 66,500, which is 26.8%. Then we have the last item, which is bank, 700 divided by 66,500, which is 1.1%. 1.1. Okay, so we go to the items of equity. We have 7,000 divided by 66,500, which will give us 10.5%. Then we have revaluation surplus, that 150 divided by 66,500, which will give us 4.7%. Retained earnings, we have 9450 divided by 66,500, which will give us 14.2%. 0.2%. What about the lease liability? 14,700 divided by 66,500, which is 22.1%. And then the 10% loan notes, 17,500 divided by 66,500, which will give us 26.3%. We go to the current liabilities. We have trade payables, 7,350 divided by 66,500, which will give us 11.1. 11.1. We have 2,450 divided by 66,500, which will give us 3.7%. And then finally we have tax, 49 divided by 66,500, which will give us 7.4%. 0.4%. Yes. So basically that is it. That what was required there. We have been able to express all items as a percentage of what? The total asset, as a percentage of total asset. And basically by doing all this, expressing these items as a percentage of total assets, basically by doing that, you get how many marks? You get 5 marks. 5 marks. Marks. And equally, for the first Roman 1 of this question, equally the marks which were located here were 5 marks. Were 5 what? 5 marks. And then from there we need to answer the last part of that question. The last part of that question. So we are told to advise the directors of Dragon Limited on the best company to acquire. Advice on best company to acquire. So between these two companies, that is Able and Cedar, which company should be acquired? Which company should be acquired? So for you to be able to, or for us to be able to give this particular advice, we base it on 2 aspects. One is the financial performance. And I think from the analysis which we did here, we said that the first company here, that is Able, this company is performing well based on these 3 ratios which we identified there. So based on the performance, the best company to acquire is what? Cedar. Number 2, you also have now to look on the financial stability of the company. So when checking on the financial stability of the company, you look on the extent to which the company is financed by the debt capital or by the borrowed capital. So therefore what you do, you come here and you check which company is financed by huge amount of debt capital. And basically in this case, when we talk about the debt capital, I think we are talking of, I think just one here. This is the main form of debt capital, the 10% loan notes. Here we can be able to see that this company is 46.9 and this company is 26 point what? 0.3. Point what? 0.3. So therefore in this case equally we can be able to recommend that this company or the directors of Dragon to acquire which company? To acquire Able. So therefore we can say advice on the best company to acquire, we can say I will advise directors of Dragon Limited to acquire as Able Limited, since it is more profitable, it is more profitable than Cedar Limited. It is more profitable than what? Cedar Limited. Basically, by giving that particular advice, you get how many marks? You get 2 marks. Yes. So basically, that is it. That what was required as far as that particular question is concerned, and that is the only question which has been tested in these particular past papers for FRA regarding what FRA is the common size analysis. Equally, that brings us now to the end of that particular topic, and the topic was analysis of financial statement. Greetings to you all and welcome to the revision session of the financial accounting paper that was done by CPA and CFA candidates on Monday, 4th of April 2022. This was a morning paper. The candidates were expected to answer 5 questions in a time period of 3 hours. And in this session, I'll be tackling a question at a time. In this first session, I'll answer question number 1. In the next session, I'll answer question number 2 until we complete the 5 questions. It's my hope that you are ready to revise. I also hope that you attended the class lectures where we took you through all the topics as per the 2021 Kasneb revised syllabus. Welcome to the lesson. Question 1 of the financial accounting paper that was done in April 2022 reads as follows. Part A, highlight 5 elements of financial statements, 5 marks. I'll first answer that one. Elements of financial statements. So candidates, what are financial statements? Financial statements are also known as the final accounts, and the main financial statements are the statement of income, or what we call the trading profit and loss account. The second one is the statement of financial position, also known as the balance sheet. The examiner required candidates to highlight 5 elements. The candidates who understand English did not have any problem answering this question, because if you know the meaning of elements, what is an element, then it becomes very easy for you to answer such a question. An element is a segment. An element is a constituent of something. An element is a section. The candidate required, the examiner required candidates to highlight 5 elements of financial statements. 5 elements of financial statements. This is financial accounting. We are revising the paper that was done in April 2022. Question number 1. A, elements of financial statements. I've said the main financial statements are the income statement and the balance sheet. So what are the sections in a statement that is known as the profit and loss account, the trading profit and loss account? So if you are to look at an income statement
or a statement of financial position, you'll find elements like revenues. And in a short while, we are going to be preparing a statement of profit and loss account. When preparing a statement of profit and loss account, which is a financial statement, the first section, the first element, the first segment is revenues. The second element in a statement of profit and loss account is what we call expenses. So these are the main elements in a statement of profit or loss account. Then the main elements in a statement of financial position, the main elements, we have assets. We have number 4, liabilities. Number 5, what we call equity. So these are the main elements of financial statements. Revenues. Now, what are revenues? Revenues are increases in assets or decreases in liabilities. What are expenses? Expenses are decreases in assets or increases in liabilities. When liabilities increase, then that is as a result of the expenses. Then there is assets. What are assets? Assets, or an asset, is a present economic resource that is controlled by an entity as a result of past events. What are liabilities? Liabilities, or a liability, is a present obligation of the entity to transfer an economic resource as a result of past events. How about equity? Equity, learners, is the residue interest in the asset of an entity after deducting all its liabilities. We know from the balance sheet equation that assets equal liabilities and equity. So if you are to make equity the subject of that formula, then equity will be equal to assets minus liabilities. So these are the main elements of financial statements. Example of revenues are things like sales, right? Revenues are items like discount received, commissions, and so on. Expenses are like airtime, telephone expenses, transport expenses, insurance expenses. You can name them, all right? Assets are like land. Land is an asset. Buildings are assets, all right? Prepayments, prepaid expenses are assets. Inventories is an asset. Then liabilities, accounts payable. Loans, those are liabilities. Okay? Equity, we're talking about here, capital. Reserves. Premium, share premium, and so on. So this would earn you how many marks? 5 marks. Identifying the elements will earn 5 marks. 1, 2, 3, 4, 5 marks. Let's now move on to answer part B. I read, Fatuma Ali commenced business as a retail chemist. Fatuma Ali commenced business as a retail chemist on 1st January 2021 with an initial capital of 30 million shillings, which she paid into her business bank account. She hired a shop manager at an annual salary of 2 million shillings. In addition, the shop manager is to receive a commission of 10% of the gross profit. During the year ended 31st December 2021, Fatuma Ali did not maintain proper books of account. After an examination of the available records, the following information was extracted. The bank statement for the year ended 31st December is as follows. We have the the receipts and the payments. Then below the bank statement, additional information number 1, I read, all sales were for cash and sales are banked. All sales were for what? Were for cash and sales are banked daily, subject to the retention of a cash float of 100,000 shillings. The following payments are made out of cash sales. We have the manager's salary, drawings, payments to suppliers, general expenses. Note number 2, I read, as at 31st December 2021, checks sent to suppliers amounted to 2.5 million had been presented to the bank for payment. Number 3, as at 31st December 2021, invoices from suppliers amounting to 8.6 million had not been paid. Number 4, as at 31st December 2021, inventory was valued at 36.5 million shillings. Number 5, depreciation per annum is to be provided on material vehicle at the rate of 25% on cost and on the shop fittings and equipment at 10% on cost. Note 6, during the year ended 31st December 2021, Fatuma Ali took goods which cost 100,000 shillings for her personal use. Required 1, statement of profit or loss for the year ended 31st December 2021. How many marks? 8 marks. 2, statement of financial position as at 31st December 2021. How many marks? 7 marks. 7 marks. This is part B. Statement of profit or loss. The name of the business? Fatuma Ali. Fatuma Ali. Fatuma Ali. Fatuma Ali. We are preparing statement of profit or loss as at what? For the year ended. The period is 31st December 2021. 31st December 2021. This is a statement of profit or loss. And in part A, we said that the elements of a profit or loss include revenues. So we're going to begin here with the revenues. The revenues are in millions. Fatuma Ali revenues. So the first revenue here is the sales. Sales. For us to calculate sales, we need a working because the sales are not provided clearly in the question. Why? Because Fatuma Ali did not maintain proper books of accounts. If Fatuma Ali prepared proper books of account, then these sales we need to pick it from the trial balance. But here, there is no trial balance. Therefore, we are going to use the information provided to determine the sales. So, working number 1 will have sales. Working 1. And from the receipts, from the bank statement, we can see we have sales amounting to 123,720 shillings. In addition, information number 1, we read that all sales were for cash and sales are banked daily. All sales are what? Were for cash. That means the customers were not allowed to pay by check. It was just by cash. And sales were banked daily, subject to retention of 100,000 shillings float. So the payments that were made out of cash sales, we have manager's salary, drawings, payments to suppliers, and general expenses. That means that when Fatuma Ali received cash from the customers, that cash was used to make cash transactions. And they are listed. So when preparing the sales account, these are the items to include in the sales account. Working 1, these are workings. 1 sales account. Sales account working 1. Now, in note number 1, candidates, we read that all sales were for cash and sales are banked daily, subject to retention of a cash float of 100,000 shillings. So all sales were for cash. What does that mean? That means that Fatuma Ali sold on cash basis. The customers paid in cash. And all the cash was banked. So if we check the bank statement, you can see the second item on the debit side of the bank statement reads sales 123,720,000. So that's the first item to recommend to record in this account, bank 123,720,000. So out of the cash that was received, 123,720,000 was banked. But we read in note number 1 that not all the cash that was received was banked. Part of that money was spent, and we've given the items here. So we're going to prepare another account, which I'll call cash account. The cash account, because some of the sales that were received were paid out of cash. And the first item there is manager's salary. The manager's salary was paid out of cash, because when you pay salaries, you credit the cash account and debit the salaries account. So here we have 1.98 million. 1.98 million. The second item, drawings, 4 million. The third item, payment to suppliers. Suppliers were paid how much? 1390. General expenses. General expenses amounting to 840 was also paid from cash. Then there is also the float, retention of 100,000. Float of 100,000. So these are the payments that were made out of the cash sales. So I'm going to have the total 1980 plus 4 million plus 1390 plus 840 plus 100 is 100, which gives me here 8,310,000. 8,310,000. So the balancing figure, we need to balance this account by transferring all these amounts, which is a total of 8,310,000. This amount we transfer to the sales account. Sales account. So this amount is transferred from cash account to the sales account. So we record here cash 8310. 8310. So these two will constitute the sales for the year. So there are sales that were banked and sales that the amounts that are used to pay these expenses, 8,310,000. I'm going to get the total 123,720. The amount that will be transferred to the statement of profit and loss is 132,030. 132,030. 30. 132,030 is the figure for sales, working number 1. 132 million and 30,000. 132 million and 30,000. That is sales for the accounting period ending 31st December 2021. So what is the cost of these sales? Cost of sales. We read from this question that Fatuma Ali commenced business as a retail chemist on 1st January 2021. That automatically tells you that Fatuma Ali did not have opening inventory because it's only been in operation for 1 year. So there is no opening inventory, but we have purchases. Purchases. Again, purchases are not provided directly from the question because the businesswoman did not maintain proper books of accounts, because if proper books of account was prepared, then we could simply pick the purchases from the trial balance. Therefore, we must have a working for purchases. Purchases, account, this is working number 2. Purchases, account. We'll go through the question and identify all the items that are to be effected or to be transferred to the purchases account. And I want you to look at the bank statement first of all. The bank statement, we have payment to suppliers of 112,360,000, payment to suppliers. You can see the bank statement is credited. Therefore, the purchases account will be debited with the bank. The amount there is payment to suppliers 112,360. 112,360. Then additional information. We read in note number 2 that as at 31st December, checks sent to suppliers amounting to 2.5 million had not been presented to the bank. So suppliers were paid there. We have checks amounting to 2.5 million. 2.5 million. Those are checks. Note number 2. In note number 3, as at 31st December, invoices from suppliers amounting to 8.6 had not been paid. So these are invoices. Invoices amounting to 860. This is 8.6 million. 8.6 million had not been paid, so we debit the purchases account with 8.6 million. Then depreciation. Note number 6, we read, during the year ended 31st December 2021, Fatuma Ali took goods which cost 100,000 for her personal use. That is an amount that we'll have to have it here as drawings. Drawings, we'll have drawings there. Then we see in note number 1, payment to suppliers. That is payment to suppliers, cash payment to suppliers. Out of the sales that were received, suppliers were paid. As we saw here, suppliers were paid. These are purchases, 1390. So these are the items that will enable us determine the purchases for the year. Purchases for the year. We are going to get the aggregate. Aggregate. We add 1,2,360 plus 2.5 plus 86 plus 1390. The total 124,850. So this is what will be transferred to the statement of profit or loss, 124,850. 124,850. 124,850 is the value for purchases. 8. This is 124,850. 124,850. Then there is the drawings of, that is the last note. During the year, Fatuma Ali took goods which cost 100,000 for her personal use. These are drawings of 100,000 shillings. Drawings, 100,000 shillings. The drawings reduce the reduction in the goods that are available. Then do you have closing inventory? Closing inventory. The closing inventory note number 4 was valued at 36.5 million. Closing inventory. Closing inventory note number 4, 36.5 million. So that will be the cost of sales. We're going to add 124,850 minus 100 minus 36.5. Cost of sales 88,250. Deduct cost of sales from sales of 132,030. The gross profit 43,780,000. This is the gross profit. I hope you are also confirming, candidates, the figures, the gross profit. Are you arriving at 43,780,000? Yes. Then the second element in the statement of profit or loss is what we call expenses. What are the expenses? We again run through the question, identify the expenses. First of all, let's look at the bank statement. Are there expenses from the bank statement? Yes, we have interest on bank loan. Interest is an expense. Interest is an expense, 1 million. Then there is the general expenses. General expenses will have a working for general expenses. Why? Because general expenses were paid through the bank. Then there were also that were paid out of cash. General expenses were paid out of cash. General expenses will be equal to the amounts that were paid through the bank of 83.35. So we have 83.35 plus the amounts that were paid from cash note number 1, general expenses 840. These two will give the total value for general expenses 83.5 plus 840. General expenses 91.75. 91.75. That's the value for general expenses. Then from the bank statement, rent was paid. Rent is an expense. Rent is an expense, 37.50. 37.50 is the value for rent. Now let's check from additional information. Do we have any expense? Manager's salary. Manager's salary is an expense. Manager's salary, that is an expense. Manager's salary is an expense. And you recall, candidates, that in sentence 2 of the question, that Fatuma Ali hired a shop manager at an annual salary of 2 million. In addition, the shop manager is to receive a commission of 10% of the gross profit. And from from the trial balance, I mean from the bank statement, there is no payment for the manager's salary, neither the commission. But in note number 1, you can see that the manager was paid 1,980,000, meaning that this manager, there is salary owing. The business owes the manager some amount, because the amount ought to be 2 million. But for the purposes of preparing the statement of profit or loss account, we need to indicate the total value, whether the money was paid or not. So the manager is paid 2 million. Are you clear on that? 2 million. That means that out of this 2 million, only 1,980,000 was paid, but 20,000 is due. That's outstanding manager salary. Then below here we need to indicate the commission. This manager we read is also paid commission of 10% on gross profit. So 10% of gross profit, the gross profit 43,780. 10% of 43,780,000 is equal to 43,78. So 10% of 43,780,000 is equal to 4,378,000. That is the commission. Is there any other expense? Yes. Look at note number 5. Depreciation per annum is to be provided on motor vehicle at the rate of 25%. Depreciation is an expense. Depreciation. This depreciation should be, the rate should be applied on motor vehicle, one motor vehicle. The rate for motor vehicle is 25% on cost. So this is 25% times the cost. The cost is to be found in the bank statement. That is item number 3 on the credit side of the bank statement, motor vehicle 2740. 2,740,000. So 25% of that is 2740, which is equal to 685,000. That is depreciation, motor vehicle depreciation. Another asset that is depreciated is fixtures and equipment. Fixtures and equipment is to be depreciated at the rate of 10% on the cost. So let's identify the cost of fittings and equipment. Fittings and equipment is the second item on the bank statement. That is 8,800,000. 8,800,000. 10% of 8,800,000 is 880,000. So candidates, what else do we have here? Going through the question again, I don't see any other expense. We have salaries. That is manager's salary. We've identified it and recorded it. These are the only expenses. So we're going to get the total expenditure, then deduct from the gross profit. Total expenditure 1 million plus 9175 plus 3750 plus 2 million plus 4378 plus 685 plus 8 80. Total expenditure 21,868, deduct from gross profit of 43,780 is equal to 21,912. That's the net profit. Net profit. Net profit. 21,912,000. We've answered part B. Let's answer part C. That is part. This is B1. Then B2, the statement of financial position for Fatuma Ali. Fatuma Ali, statement of financial position as at 31st December. Statement of financial position. What are the elements of a statement of financial position? Assets. The first element. We're going to record the non-current assets first. Non-current assets. So we're going to have here the cost, net book value, the depreciation, and the cost in thousands. The first asset is leasehold premises. Leasehold premises, 20 million, zero depreciation, 20 million book value. The next one is fittings and equipment. Fittings and equipment, cost 8.8 million. Depreciation on fittings, these are fittings and equipment depreciation, 880. 880. Net book value is a difference between the cost and the depreciation, 800 minus 880, net book value 7920. Motor vehicle, cost of motor vehicle 2740. Depreciation on motor vehicle is 685. Net book value is the difference between the cost and the accumulated depreciation. The difference 2740 minus 685, and net book value 2,055,000. These are the non-current assets. Going to total here and close, total there and close, total but don't close. Then we move on to the current assets. Current assets. The first current asset here is inventory. Closing inventory, note number 4, 36.5 million. 36.5 million. The next one is bank, that is a balance carried forward, that is balance carried forward or balance carried down, 16,735, 16,735. What else? I draw attention to note number 1. All sales were for cash and sales are bank daily subject to retention of a cash float. So that is a cash, which is a current asset, 100,000. So we get the total. We'll add to the non-current assets. I'm moving on to calculate the liabilities. This will give us the total assets. Let me get the total assets. Total assets, I'm adding here the net book values, 20 million plus 79, 20 plus 2055, 29, 975. Going to add the current assets, 36.5 million, 36.5 million plus 167.35 plus 100, 53,335. Total assets plus 29,975. Total assets 83,310. So these total assets are financed by, first of all, we have capital. From the first statement, we read that Fatuma Ali commenced business with the initial capital of 30 million. So capital here, 30 million. Then there is, we add the net profit for the year, 21,912, 21,912, 21,912, and then before I get the total here, I'm going to deduct the drawings. Drawings from the cash account, we saw that Fatuma Ali withdrew 4 million. 4 million, that is from cash. When you check the last additional information, we read that Ali took goods. Fatuma Ali took goods worth 100,000. These are drawings in form of goods. So we add to the cash, giving a total of 4.1 million. This we deduct. Drawings reduce the capital. So we are going to add the 30 million plus profit 21,912 minus 4.1. So here we have capital of 47,812. Then these total assets were also financed by non-current liabilities. Non-current liabilities. We have one non-current liability known as bank loan. The loan is a non-current liability because Fatuma Ali is expected to repay this loan for a period of more than 12 months. So there is a bank loan on the debit side of the bank statement, 20 million. 20 million. We are going to add current liabilities. Current liabilities. The first current liability is accounts payable. Accounts payable. Candidates, accounts payable, you can see in note number 2, checks sent to suppliers amounted to 2.5. Had not been presented to the bank. Okay? 2.5. Then in note number 1, we read that payments were made to suppliers. So we are going to add, as at 31st December 2021, checks sent to suppliers amounted to 2.5 had not been presented to the bank. That means that these suppliers had not been paid, because for the suppliers to be paid, the checks must be presented to the bank. They must be presented to the bank. That means the amount was not deducted from Fatuma Ali's account. So that still remains a liability. But in note number 1, we have those suppliers that were paid. 1.39 million was paid from cash, and therefore the accounts payable will be equal to 2.5 million plus note number 3, invoices from suppliers amounting to 8.6 had not been paid. These are invoices to suppliers that had not been paid. Suppliers had supplied the goods, but they had not been paid. So if they had not been paid, then that's a liability, 8.6 million, 8,600. So we're going to add 2.5, 2,500 plus 86. So total current liability for this account payable, 11,100,000. Then another item here under current liabilities, remember the manager's salary. The manager's salary is 2 million per year. From the bank statement, we read that the manager was only paid, that is from the cash, manager was only paid 1,980,000, meaning that there is accrued salary. Or let me write salary due, the same thing, or salary outstanding, salary, manager's salary due, 20 million. The manager was expected to be paid 2 million, but he was only paid 1,980,000, meaning 20,000 is due. Then from the records provided, there is no account where the manager's commission is to be paid. We read that the shop manager is to receive a commission of 10% of the gross profit. From the bank statement and the cash payment, no commission was paid. So therefore, that commission is also a liability. Commission due, we had calculated the commission due here, 43.78. 43.78. So these are the liabilities. We have the long-term liability, 20 million. Then the short-term liabilities, I'm going to add the short-term liabilities, 111,000 plus 20 plus 43.78, 15,49,8 plus 20 million plus 47,812. So I'm getting here 83,310,000. This is total equity or capital and liabilities. The total equity total equity plus liabilities should always be equal to the total assets. You can see here the total assets 83,310,000, 83,310,000. So that marks the end of the question. We've done part A of the question, 5 marks. Part B, Roman 1 of the question, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. All these marks give a total of 8 marks, or the ticks will earn 8 marks. Then we have the net book values here: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. The 16 ticks will earn you 8 marks. These are they 8? These are 7 marks. 7 marks. So, learners, this is a question that tested the candidate's knowledge in preparation of the financial statements from incomplete records. Fatuma Ali did not prepare complete records, did not maintain proper books of accounts. So I want you to expose yourself to various scenarios of improper records. This question can come in various ways. We covered this one in the normal video lectures. We've done several past paper questions in relation to preparation of statement of financial position based on incomplete records or improper books of accounts. And if you have any question, please feel free to send it. Below this video, there is a comment section where you can post your questions, and all your questions will be answered. In our next session, we're going to answer question number 3. I urge you to go through question number 3, attempt it. It's a question testing you on the area of not-for-profit making organizations. This is the financial statements of the organizations that whose objective is not to make profit. Thank you. God bless you. Bye-bye.
Yes, good day, my student. Welcome back to Manifested Online Classes. My name is Joseph Kimani, and in this session, or basically in this class, I want us to look on an illustration question regarding the topic of public financial statement. Remember, in our previous classes, we have already looked on how we prepare the statement of comprehensive income, statement of financial position, statement of changes in equity. And in this class, I want us to illustrate how we present the same using a past paper question. I want us to go through the question, and then from there we look on what was required. So the question reads: the following trial balance related to BD Limited as at 31st of December 2022. So we are given a trial balance for BD Limited at the end of the year. First of all, we have the property at cost, and you're told property include a building. Generally, if you're given property include land and building. So in our case, you're told the value of building is 400 million. So mean that the difference between 600 and 400 is the value of land. We have plant at cost, motor vehicles at cost, office equipment at cost, accumulated depreciation as at 1st January 2022 for buildings, plant, motor vehicles, office equipment. And then we have the inventory at the start of the year, purchases at cost, distribution cost, administrative expenses, revenue, trade receivables, and trade payables. We have the bank balance. We have the deferred tax, current tax, bank interest. And then from there we have the ordinary share capital, the share premium, the retained profit as at 1st January 2022, interim dividends paid, and then we have suspense. Then from there we have some additional information, note number 1 up to note number 6. And then what are we required? We are required to prepare the statement of, we are required to prepare the following financial statements in a suitable format for publication. In other terms, we are required to prepare 3 components here of financial statements in a format suitable for publication. 1, we are required to prepare the statement of profit or loss for the year which ended 31st of December 2022. B, a statement of changes in equity for the year which ended 31st of December 2022. And C, a statement of financial possession as at 31st of December 2022. Now, before we prepare what was being required here, definitely we need to go through the additional information. We see what we are told, and equally we see whether there is any working which is required. So in additional information number 1, you are told, during the year which ended 31st of December 2022, BD Limited disposed of an item of plant for cash proceeds of shillings 20 million, which were credited in the revenue account, and we are told no other accounting entries were made. The plant had a cost of 39.7 million and had an accumulated depreciation of 15.86 million. And then in the other point, you are told any gain or loss on disposal should be included within the cost of sale. So what you are told here is that this company disposed, or in other terms, sold an item of plant at an amount of 20 million. So this 20 million, which was received from the sale of the plant, we are told it was included as part of the revenue. First of all, that is wrong, because whenever the company sells an asset, that is a capital income. It should not be included in the revenue of the company. So therefore, when preparing the statement of profit or loss, what we are going to do, from the figure for revenue, we are going to less that 20 million. 2, anytime the company disposes or sells an asset, you have to prepare an account called disposal account for you to determine whether that item was disposed at a gain or at what? At a loss. And actually, we are told that profit, all the loss on disposal should be part of what? Part of the cost of sale. So therefore, let's start with that working. Remember, this illustration. This is illustration on the topic of published. So we start with the workings. We start with workings, and working 1 will be the preparation of the disposal account. I've said this is an account which is prepared anytime the company do what? Sells or disposes an asset, and we prepare this account to determine whether the asset was disposed at a gain or at what? At a loss. So how do we prepare this account? We prepare this account by debiting it with a cost, crediting it with 2 items, the accumulated depreciation and also the sales proceed. Then from there we balance our account. Any balancing figure on this side is a loss on disposal. Any balancing figure on this side is a gain on what? Disposal. So we are given those items. 1, we are told we are given the cash proceeds. The cash proceeds is the amount which was received by the company after selling that asset. And if you check on the figures given in the trial balance, our figures are given in thousands of shillings. So therefore, for us to be consistent, we have to work with all our figures in thousands of shillings. So 20 million is the sales proceeds. And then we are also told that this plant had a cost. The cost was 39,700. That is a cost. And then we also given the accumulated depreciation as 15. Okay, that is the accumulated depreciation we recorded up there. 15 what? 15,860. So what we need to do, we balance our account here, and the balancing figure, if on the debit side is a gain, if on the credit side is what? If on the credit side is a loss. Is a loss. So let's add what we have on the credit, 15,860 plus 20,000. So that will give us 35,860. So mean that this side is more, and therefore our balancing figure will be on which side? It will be on the credit side. And how much will be our loss? It will be, we take that minus what we have on the debit, 39,700, and that will give us 38 what? 40. So this particular 38.40, this is what? This is the loss on what? The loss on disposal. And what you're told is that this particular loss on disposal should be included as part of the cost of sales. And basically that's what we said in our previous class, that any gain or loss on disposal should be part of the cost of what? Sales. So that will be added in the cost of sales. And equally, we have said as far as that point is concerned, there are a number of adjustments we are going to make. The 20 million, this is the amount received from the selling that particular plant. We are told it was included as part of revenue. That is wrong. We are going to less that from the revenue. And then we also told that this particular plant which was disposed or which was sold had not been accounted for. What the company had accounted for is purely the amount received. And therefore, this plant which was disposed, we are going to less it from the plant of this company. The moment the company sells an asset, disposes an asset, such an asset should be derecognized. It should be removed from the company's books of accounts. That was not done. So therefore, we are going to make that adjustment, but you're going to make that adjustment specifically when preparing what is required in Part C. So let's move to the last point of note number 1. And you're told it is a policy, it is the company's policy to provide a full year depreciation in the year of asset purchase and none in the year of disposal. It basically means that whenever the company has acquired an asset in a certain year, even if the asset is acquired some few months at the end of the year, the company provide a full year depreciation, but none, no depreciation which is provided in the year of disposal. Basically, that information is to help you in terms of computing the depreciation for plant in note 2, because there was this plant which was disposed during the current year. So this plant which was disposed during the current year, no depreciation will be provided as far as that plant is what concerned. But you're going to use that information in note 2. So let's go to note number 2. And you're told depreciation on plant, property, plant and equipment is to be provided and allocated as follows. So let's compute those particular depreciations. As per note number 2, we compute the depreciation of items of PPE. We start by computing depreciation of the first item, which is what? Which is buildings. Buildings. So we are told buildings are depreciated at the rate of 2.5%. Using which method? Using straight line. So at a straight line, you have to recall we compute depreciation based on the cost. So what is the cost of buildings in the trial balance? The cost of buildings is 400 million. So we get 2% of 2.5% of that, 2.5% of that. And then also in note number 2, we compute the depreciation on plant, which is at the rate of 10%. Using which method? The reducing balance method. So under the reducing balance method, we compute depreciation based on what? Based on the net book value. Based on the net book what? Value. So what will be the net book value of a plant and the plant? So we take the cost, which is 280, and then we less the accumulated depreciation, which is 111, 116, 16. But now equally here, you have to remember there was this plant which was disposed. So therefore, because no depreciation which is provided in the year of disposal, we automatically need to eliminate that particular plant here. And basically we eliminate it here at its net book value. So what will be the net book value of that plant? So the net book value of this plant which was disposed will be, its net book value will be equal to its cost, which we have here, that is 39,700 minus the accumulated depreciation, which is 15,860. So that will give us now the net book value of this particular plant which was disposed, which was sold during the current year. We have 39,700 minus 15,860. So that will give us a net book value of 23,840. So because it's part of this and we are told no depreciation in the year of disposal, we need to deduct it there, 23,840. And basically you can see we are deducting it there at what? At net book value. So we are going to come back and compute these particular depreciations. Then let's go back to note number 2, depreciation on motor vehicles, which is at the rate of 20%. Using which method? Straight lines. At a straight line, we compute depreciation based on cost. The cost of motor vehicles is 70 million. So we will compute that. We go back to note number 2. We compute depreciation on office equipment. Office equipment, which is 12.5%. Using straight line. Straight line, we compute depreciation based on what? Based on the cost. Based on the cost. Yes. So what now we need to do, we compute these particular depreciations. And remember in our case here, what you have said is that depreciations on items of PPE, this one is included as part of the cost of sales unless told otherwise. If you go back to that particular point, you'll be able to see how those particular depreciations are supposed to be classified. For example, depreciation on building is administrative and so on. But you have said if the question is silent, you always account for this depreciation as part of the cost of sales. So let's compute this. We start with the depreciation on buildings, which will be 2.5%. 2.5% times 400,000. 400,000. So that will give us what? That will give us 10,000. Will give us a figure of what? 10,000. 10,000. And then you are told that this particular depreciation on buildings, as per note number 2, this one will be part of administrative expenses. Will be part of the administrative what? Expenses. That is important. Then let's compute the depreciation on plant. First of all, we compute this, and this was a figure of 280,000. This is a 280,000. 280,000. I hope that is correct. 280,000. Yes, we take 280,000. 280,000 minus 111, 160. 111, 160. I hope that also figure is correct. 111, 160. So and then to this we less now the net book value of the plant which was disposed, 23,840. Okay, and then we get 10% of that, which will give us 14,500. 14,500. How is this depreciation to be accounted for? As per note number 2, this will be part of the cost of sales. This will be part of the cost of sales. Then let's compute the depreciation on motor vehicles, which is 20% of the cost, which is 70. And that will give us 14,000. As per note number 2, this depreciation on motor vehicle should be classified as part of distribution cost. Part of distribution cost. Then we compute depreciation on equipment, which is 12.5% of the cost. And this will give us what? 5,000. 5,000. And equally, as per note number 2, this is a part of admin. This is part of the administrative what? Expenses. So those are the depreciations. So and I think we are done with that particular point. Let's move to point number 3. In point number 3, what are we told? We are told that it has been discovered that the former financial controller of BD Limited engaged or basically was engaged in fraudulent financial reporting of shillings 12 million of trade receivables that were non-existent and need to be written off. So basically what that means that the former financial controller of this company included in the receivables an amount of 12 million which are non-existent receivables, and therefore they need to be written off. So we are told that out of this amount, 7 million relate to the year which ended 31st of December 2022, which is now the current year. And therefore, that particular amount of 7 million which relate to the current year, we are going to write it off and basically include it as an expense for the current financial year. So remember, these bad debts which are written off, this is written off as a result of a decision which has been made by the board or basically by the management. And therefore, such an expense which arises as a result of a decision which is made by the management of the company, by the board of directors, then we classify that as part of administrative what? Expenses. And then you're told with the balance relating to the prior what? year. So therefore, those particular bad debts which are to be written off, which are for non-existence receivables, bad debts written off, bad debt written off. So in that case, we are told that is an amount of 12 million, is an amount of 12 million, but we said we are working with all our figures in thousands of shillings. So we are told 7,000 relate to the current year. So therefore, in preparing our income statement, this one we are going to include it as part of admin, and then now the difference, which is 5 million, this one is a prior year adjustment. Is a prior year what? Adjustment. Basically what that means, this amount of 5 million, it relates to the previous year. We don't include it in the income statement for the current what? Yeah, it's not an expense for the current year. So what we do, we adjust it in the opening what? The opening retained profit or the retained what? Earnings, because it was an amount which was supposed to be written off in the previous years, but it was not written off. So what we are only including in the income statement for the current year is 7 million. So let's go to note number 4. And in note number 4, we are told the existing debit balance on the current account in the trial balance represent the adder or over provision for previous year's tax. So if you go back to the trial balance, there is an item which you are given there, which is an item of current tax. So that item is below the bank balance, is below the deferred tax, and that item is an amount of 2600, 2600, the item of current tax, and you can see these are debit balance. It is on the debit side of the trial balance. So this particular amount here, this one is what? Is under provision. Is under provision of what? Of current tax. Because under provision of current tax from the previous years has a debit balance, in the trial balance. But if it was over provision will be having a credit balance. That is something which the examiner will not tell you, but any other provision of current tax from the previous year, this one will always be having a debit balance in the trial balance, and any over provision of current tax in the from the previous year, this will be having a credit what? Balance. This is something you'll come across in most of the questions for published, but the examiner will not have specified whether it is over or other. Is upon you to know that other provision has a debit balance, other provision has what? Has a over provision has a credit balance. So therefore, that is over. That item which we have is other provision. So how do we treat other provision of current tax from the previous year? So such other provision, we bring it forward to the current year and we add it. We do what? We add it to the current year's estimated tax liability. We add it to the current year's estimated tax what? Liability. But if it was an over provision, we bring it forward to the current financial year and we less it from the current year's estimated tax what? Liability. That's basically what you need to know, and therefore that's what you are going to do as far as that other provision is concerned. And then you are told, number 4, the second sentence, we are told the provision for current tax for the current year, that is the year which ended 31st of December 2022, was 42 million, or was 52 million. 52 million is required, together with a decrease to the deferred tax provision of 3 million. So therefore, we are told the estimated tax liability for the current year is 52 million. So mean that we need to determine the amount of current tax to be charged in the income statement. So the amount of current tax to be charged in the income statement, what we do is that we take the current year's tax estimate, which is 52 million. But remember, in the previous year, we had other provision. The other provision which we have in the trial balance of how much? Of 26. And you have said that that other provision from the previous year, we added to the current year's tax what? Estimate. And this will give us now a total of 54,600. So this is the amount of current tax to be charged in the income what? Statement. In the same point, we are told there was a decrease in deferred tax provision. A decrease in deferred tax provision in the income statement, that one is accounted for as a deferred tax income. As a deferred tax what? Income. So because it's a decrease. Just the same way how we account for a decrease in provision for doubtful debt. A decrease in provision for doubtful debt, we account for it as an income. But an increase in any provision is accounted for as an expense. So therefore, that amount of 3 million, that is a deferred, tax income. A deferred tax income of how much? Of 3 million, Remember now these two items will be adjusted in the profit before tax. That's what we said in our previous or in the introduction class, that to the profit before tax we adjust two items, the current tax and also the deferred tax income, or what? Or expense. So we have that. Then let's move to the other note, note number 5. And note 5, we are given the inventory at the end of the year. This is now the closing inventory, no working which is required. And then number 6, you are told on 30th of December 2022, the company directors invited the current shareholders to subscribe for a right issue on the basis of 1 share for every 5 shares which were held at an exercise price of 15. And then you're told the come right price on the last day of trading was 20 shillings per share. So, and then you're told the proceeds from the fully subscribed right issue were credited in the suspense account. So I think what we need to do there is to determine how many shares were issued by the company during the right issue. How many shares were issued by the company during the right issue? So we are told this right issue which was made by the company to the existing shareholders, it was on the basis of 1 share, 1 share for every 5 shares held. For every 5 shares which were held. So what we need to do first of all is to determine the shares held by this company, not held by this company, but the shares held by the members, the shareholders of this company. How do we determine that? We take the ordinary share capital of the company, which is given in the trial balance, which is 200,000. And to determine now the shares issued by the company, we divide that with the par value. The par value is the value per share given in the trial balance, which is 10. And this will give us 20,000 shares. So these are the shares which were held by the shareholders of the company. So the company was to, during the right issue, was to issue 1 share for every 5 shares which were held. The shares which were held were 20,000. So we need to determine how many shares were issued during the right issue. We take 1 times 20,000, we cross multiply, then we divide. Divided that with what? With 5. So this will give us what? 4,000 what? Shares. And we are told that these shares were issued at an exercise price of 15. So therefore what we need to do, we multiply the 2, and basically this will give us the amount which was received by what? By the company. The amount received by the company from the right issue, which automatically this one will give us what? 60,000. Now what you are told is that this particular amount in the last sentence of note number 6, the proceeds, the amount received by the company was credited in the suspense. Was that correct? No. Because what we know is that once the company make a right issue, the amount which was received should be debited in the bank account, That entry was made, but now the company credited suspense account. Is this what the company was supposed to do? No. So because these are shares which were issued, this account is not the one which was supposed to be credited, but the company was supposed to credit which account? The company was supposed to want to credit the ordinary share capital account. The amount credited in this account is always based on the par value per share. You take the shares issued by the company, 4,000, times the par value. The par value is the amount is the value per share we have in the trial balance, which we know is 10. So the amount to be credited in this account will be what? 40,000. So this amount of 40,000, we are going to add it to the ordinary share capital of the company. And then the amount which is above 10 shillings. You remember the shares were issued at 15. The amount which is above 10 shillings is a premium. So therefore, that would be credited in which account? The share premium. The shares issued, 4,000 times what? 5. Times 5 times 5. So the total, which is 20,000, that is a share what? A premium. So therefore, the adjustment which will be made as far as that note is concerned is that when preparing the statement of changes in equity, to the ordinary share capital, we are going to add 40,000. To the share premium, we are going to add what? 20,000 in relation to these particular shares which were issued by the company during the current year. And I think we are through now with the notes. What we need to do, basically, we can proceed and prepare what is required. So let's start with the part A of that particular question. And what is required is the statement of profit or loss. So first of all, we need to have the name of the company. The name of the company is BD Limited. And this is a statement of a profit or loss. Statement of profit or loss for the year which ended 31st of December 2022. 31st of December 2022. So that is basically our title there. Our title. And then now we have to use the format which I gave you. Remember, I gave you the format for this. That is the exact format we use here. So, and remember, all our figures are in thousands of shillings. And here we only have one what? One column. So what do we start with here? We always start with the revenue. The revenue. And the revenue is something which is given in the trial balance. The revenue for this company in the trial balance is given as a figure of what? As a figure of 11,23,500. But remember, there is an adjustment which you are going to make here as far as note number 1 is concerned. So this plant which was disposed by the company, we are told this amount which was received, the sales proceeds, this was included as part of the revenue. Yes, so to this figure, we need to less 20,000, which was included here as the amount which was received from selling the asset. That amount should not be recognized as a revenue because this is basically a capital income, a capital revenue. So any amount realized from the selling an asset should not be included here. So I think that now will give us a figure of what? A figure of 11,03,500. So, but we can confirm that. Let's confirm whether that is correct. So we have 11,23,500 minus 20,000. Minus 20,000, that will give us 11,035,500. And then to this, what do we need to do? We need to less the cost of sales. We need to less the cost of what? The cost of sales. Cost of sales. Now, are we given the cost of sales? No, we have to compute it. Remember, I gave you the formula for computing this. We take the opening inventory plus purchases minus closing inventory plus any depreciation plus any loss on disposal minus any gain on disposal. So what we include here, one is the opening inventory, which is given in the trial balance, 138,000. To this we add purchases, which is just below the opening inventory, which is 667,000. To this we less the closing inventory. Where do we have the closing inventory? Note addition information number 5, which is an amount of 85,000. And then to this we add any loss on disposal. Remember, here we have a loss on disposal, which is 3840, and any depreciation on PP. We have various depreciations here, and part of them should be included as part of the cost of sales, starting with the depreciation on plant, which is 14.5. Do we have any other depreciation which should be included as part of the cost of sales? No. So that's how we are going to arrive at the figure for the cost of sales. Opening inventory, purchases, closing inventory, loss on disposal, and then the what? And then this depreciation on what? On plant. So let's get the final figure here. We get the final figure. So we have what? We have 138,000 138,000 plus 667,000 minus 85,000 plus 3840 minus 14,500 and that will give us a figure of what? It will give us a figure of 709,340. 709,340. 709,340. So we less that from our revenue up there, and whatever you get here is the gross profit. The gross profit. So how much would be our gross profit? We deduct that from 1103 500, and this will give us a 598,990. That is our gross profit. So to this gross profit, next we said we add other income. So when checking for other incomes, what basically you do, you go back to the trial balance and you check other incomes on the credit side. All incomes, they have a credit balance. So you go through the items on the credit side of the trial balance, we see whether we have any other income. Up there you can see we have accumulated depreciations. Those are not incomes. Down here we have revenue, payables, bank balance, and then deferred tax. And then we have ordinary share capital, share premium, retained profit, and down there we have what? Suspense. So basically in our case here, we don't have any other income. We don't have any other what? Any other incomes. We don't have any other what? Income. So then to this we go straight to deducting our expenses. Our expenses, we can start with just what we have in our trial balance. Below the opening inventory and purchases, we have the distribution cost. Distribution cost. So the distribution cost in our trial balance is given as an amount of 44,000. So there are some depreciation which are part of the distribution, and that is the depreciation on what? On motor vehicles. So that one we included here. And that is an amount of depreciation on motor vehicles is an amount of 14,000. So this will give us a total of 58,000. So below the distribution we have the admin expenses, administrative expenses. So equally that need to be adjusted. We can do our adjustment with here. So we have 93,500. So then we need to include the depreciation on what? On buildings, which is 10,000. And then also this depreciation on what? On office equipment, which is 5,000. Which is 5,000. There is something you should also, we also need to remember to include here. There was this bad debt which was to be written off and which related to the current financial year. The amount of how much? 7,000. We said it should also be part of administrative expenses. Yes. So I think now we can get the total administrative expenses. We have 93,500 plus 10,000 plus 5,000, or we can just take 5,000 plus 7, which will give us a total of 12. Yes, and that will give us total administrative expenses of 115,500. And then below the administrative expenses, I think we have revenue. Okay, we have trade receivables, bank balance, deferred, current, and then we have the bank interest. Now this bank interest will be included here, but we include it here as part of the finance cost. And I think this is the only item which will form part of the finance cost, and that is an amount of how much? That is an amount of 24. And then now what we need to do is we check whether we have any other expense, or this company had any other expense which which has not been classified as part of cost of sales, distribution, admin, or what? Finance. So we just go through the trial balance and we check the items which we have on the debit column, because all expenses, they have a debit balance. So first of all, up there we have assets. Those are not expenses. Down there I can see inventory purchases. Those are not expenses. We have already captured distribution, admin. Down there we have receivables, that is an asset. Down there we have current tax. Remember that was under provision. That is not an expense. Bank interest, we have already captured that there in our income statement as what? As finance costs. And then down there we have interim dividend. So basically that is not what? An expense. And I think then what we have in the additional information, number one, we had the loss on disposal. We have already captured that as part of cost of sales. Note 2, we have these 4 depreciations. Depreciation on buildings, that was supposed to be included as part of what? Admin. We can confirm whether this has been included as part of the admin. 10,000 is there. Then depreciation on plant is part of the cost of sales. Have we included that here? Yes. Motor vehicles, its depreciation is part of distribution. 14,000. Have we included as part of the distribution? Yes. Office equipment, its depreciation is part of admin. 5,000. Has it been included as part of that? Yes. Okay. And then number 3, we have this amount to be written of 7, which should be part of admin. Have we included that there? Yes. And then number 4 is about tax, current and deferred. That will be deducted from our profit before tax. And then number 6 is all about, number 5 is about closing inventory. We capture that there. Number 6 is about late issue. That do not affect our what? Expenses. So basically what that means is that we don't have any other expense. We don't have any other expense. So what we need to do here is we get the profit before tax. The profit before tax. Our profit before tax will be, we take now the total incomes minus the expenses there. So we have 598,990 minus 58,000 minus 115,500 minus 2,400, and that will give us a figure of what? A figure of 423,090. So that is the profit before tax. And then to this we need to less what? We need to less the income tax expense. Income tax what? Expense. And for the income tax expense, this comprises of 2 components of tax. The current tax. And the current tax, we computed that figure there, which is 54,600. And then we also have the component of deferred tax. What did we have here? We had the deferred tax income. Deferred tax income. And because this is an income, a deferred tax income, we don't less it from our profit, but rather what we do, we add it. That's why we refer to it as a deferred tax what? A deferred tax income. So we take our figure here, which is 423,090 minus 54,600 plus 3,000. And that will give us 371 for what? 490. So what is this? This is the profit for the year. The profit for the year. So to this profit for the year, we said then we proceed and we add other comprehensive incomes. Other comprehensive what? Incomes. Other comprehensive incomes, we said these include revaluation gain or loss on PPE, revaluation gain or loss on a financial asset at fair value through other comprehensive income. But if you check on what we have in this particular question here, we don't have any other comprehensive what? Income. So basically what that means is that our total comprehensive incomes will be the same with the profit for the year, 371 for what? 490. So basically that is it. That's what was required as far as Roman 1 of that question is what? is concerned, or part A of that question is concerned. So let's move to part B of that question. Part B, the examiner was requiring the preparation of the statement of changes in equity. Statement of changes in equity for the year which ended 31st of December 2022. Now remember, we say that this is prepared basically to show or to explain why there was a change in the various items of what? Of equity. In preparing this statement, we have said we start with the details column, and then we identify the items of equity our company had during that year. So items of equity include ordinary share capital and items of reserves. So if we go back to the trial balance, I think from where we have ordinary share capital, that is the first item, share premium, the second one, retained profits, that is the third one. Do we have any other like general reserve and revaluation reserve? No. So mean that in our case, we only have 3 items of equity, and then automatically we need to have what? We need to have the total what? The total column. The total column. So let's have those columns here. We have those columns here. I've said we have, we're going to have a number of columns. The first one will be the details column, details column, and then ordinary share capital, share premium, and then retained what? Retained profit, and then the total column, Also our figures here, we indicate they are in thousands of shillings. So what do we start with here? We always start with the opening balances. Balances brought down. So the balances brought down, these are the figures we have in the trial balance. For ordinary share capital, the opening balance was 200,000, share premium 50,000, retained profits 223, 640. Then what we need to do, basically we get now the totals. So we have 200,000 plus 50,000 plus 223, 223. 640, and that will give us a total of 473, 640. And then what we need to do is basically to take into account the transactions which occurred during the current year and which affected those items. The first adjustment which we need to make to this particular retained profit is what we were given in the additional information number 5. Not number 5, but not number 3, in relation to this particular budgets which was supposed to be written off, which related to the prior years. Remember, we said that this is a prior year adjustment. So therefore, the first adjustment we make is to adjust this opening balance with the prior year adjustment. We say that